Welcome to day 2 of the STEM Virtual Investor Conference, where we're putting a spotlight on opportunities in science, technology, engineering, and mathematics. Today, you'll hear from companies presenting in sectors such as agri-tech, clean tech, renewable energy, education, and digital media. And as exactly what I said yesterday, same as this, these sectors are being transformed as we speak. Over the next decade and even 2 decades, we are going to be seeing industries wiped out. For every investor, you understand that that comes with challenges in some ways, but it also comes with the greatest opportunities that we get to see as investors. More than that, we know with this type of enablement and also disruption, not only does it disrupt or replace what's existing, but then it tends to have a multiplication effect where those sectors will grow in size and new opportunities get created by sometimes 5 times, other times 10x. And we've seen that in so many different areas. And I said, every sector I've highlighted now is a perfect example of that. And I said, I love that we get to feature many of those in the agriculture and the renewable and so forth. I said, for you guys, you're in such a treat with the opportunities being featured today. Now, as a keynote speaker, we have one of my good friends and an advisor to Wholesale Investor, Mr. Wee Meng Thoo. Whatever you are doing, stop it. Make sure you hear this session. He has been such a role model for me and someone that's provided so much enlightenment on what's happening in the actual innovation space. His perspective is global. The opportunities that he gets access to, very few of us do. And whenever he speaks, I listen intently and I'm taking notes. So as far as keynote sessions go, absolutely make sure you do not miss Wee Meng's session. For the panel sessions today, we are going to be talking to investors and founders. And as part of this is an engagement really in the sense that we want you to understand what both sides are actually seeing and also the opportunities that are reflected on both sides. So for you as an investor, you get 2 sides of the equation and you can help form your own investment thesis over this next sort of 5, 10 years, etc. Now, of course, all the networking is done inside our event at Brella. You would have received an email about it, you received a notification, etc. And as I mentioned yesterday, if you haven't registered inside Brella, there's AI matchmaking that's used inside the actual platform. It will help match you with relevant opportunities based on what you're interested in, etc. And obviously, the other thing to do is whilst the companies are presenting, you can go and have a look at their booths, you can have a look at their deal rooms inside Crisp. We've done everything we can to make it simple for you to get access to the information. So, enjoy day 2 of the STEM Virtual Investor Conference. We look forward to catching up with you at the end.
Welcome to the Wholesale Investor STEM Investor Showcase event. And thank you very much for inviting me for this keynote session. Now, today, I'm going to talk about why is it so important for us to look into the STEM investment, especially now in the post-COVID-19 situation. So before I start, I'd like to just give a very high-level introduction of ourselves. So we are actually a single family office backed fund based in Singapore. And we pride ourselves very much because we have been extensively investing into disruptive technology all these years. And a lot of the achievement were in the past during this e-commerce time where one of our home run is Alibaba Group. And of course, we have a few more home run, as you can see, one of which is also Tesla. The team in Leonie Hill Capital is very much comprises of very highly experienced fund managers. Like myself, I spent over 15 years in the tech industry, from Hewlett-Packard, VMware, NEC Cloud. So we've got a lot of the experience on the ground, looking into how to build tech ventures over the world. But this is a cross-industry fund. We have been also investing into recently a lot into the energy transition over the world. And we will continue to build sustainability into our investment pipeline. So I am invited to talk about the STEM investment today. And I think let me just touch on that COVID-19 situation has given a lot of pains to us in the whole world, to the whole world. And but it has also presented opportunities for us as investment specialists. And we are really looking into creating more initiative down the road, recognizing that it's so important, right, to harness more innovation, uses technologies to see how we could tackle this whole serious pandemic issue. So we have pledged as a fund to look at more investment down the road, especially in the area of where ventures and private ventures where we are able to contribute in response to COVID-19 pandemic. As you can see, I think the digitalization is here to accelerate. And we think that this whole digital infrastructure is going to be really the foundation, how we live, how we work, and in this whole post COVID-19 world. And we are looking beyond just making money. In fact, we are looking into a lot of initiative around the world, helping some of those public institutions to look at, and the government agencies to look at how they are able to leverage on technologies to help them solve some of their national issues. And I want to say is that we are quite active now, looking into how to look at solving some of those more pain points in the area of logistics, how to deploy medical aids, and how do we ease the pressure of medical staff. So a lot of the effort now has been channeled into the healthcare sector. And I think we ought to do that because we, as a financial institution, we look at just beyond making money. And this is really for the good of the world. Some of those activities that has been keeping us really busy for the past month. And I like to highlight a few of some of those that I'm very, very passionate in doing it. I think one of which we all know that testing of the COVID-19 virus has been really a bottleneck to a lot of those public health institutions. And we had actually mobilized some of our tech companies to use artificial intelligence, looking into how to deploy algorithms that has been proven in the past, uses into the lung-related diseases, that now it can be deployed into the use of the primary, the point of contact for COVID-19 response. So we had deployed one of these very interesting algorithm-based AI technology into India, and currently is being used extensively. And as a result, we are one of those tech companies that has been working very strategically, actively with the Indian government. Second is, as you know, that this pandemic has given a lot of stress to the infrastructure in the healthcare sector. And what we have done is that to build labs, the mobile lab, and those labs are as comprehensive, extensive, and also very safe, that complies into the entire standards, that we are able to deploy them into rural areas. So in this case, we were working with the Indonesian authorities, helping to bring those labs, deploy them to the villages so that those village and townships healthcare workers is able to use these facilities in response to the COVID-19 crisis. Last but not least, this is one of the most exciting things that I've been working on. is really to bring the solution to this entire pandemic. So we have been working with some vaccine developers. And in this case, I'd like to highlight that we are involved in the disruptive technology that uses vaccines to be encapsulated into a capsule form. So what it makes a difference is this is not going to be via a injection kind of model, but we are looking ahead to deploy this vaccine via post. So can you imagine that we have put into a capsule form, send it delivered to your house, to all the homes, and they will just take it into like a pill to get themselves vaccinated. So this is in the final stage of human trial. We are very excited over this exercise, and we hope that in the coming months, hopefully the first quarter of next year, we'll be able to start manufacturing them so that we'll be able to distribute this globally. So as an investor, we are constantly looking into how we can make ourselves relevant, but more important, creating an impact to the world. And I like to highlight that we as investors really have to play a more critical role in the coming years, because as you can see that, a lot of these we are in the turbulent times, and a lot of this market disruption is happening. So whether we are in the pandemic crisis now or we are facing a political issue, we ought to really look at re-examining our purpose and the strategy of how we are building this whole ventures, innovations to the world. And I like to highlight that, as a regulated financial institute, I think we ought to play a more active and critical role. And one of which is most important is to really look at how we can become more environmental and socially responsible. So I would encourage that to all these fund managers to start really looking into how to incorporate the ESG consideration into your entire investment process. So what we have did since 7 years ago, we started this process, and today it helped to give us a broader perspective in looking to how we look at the investment business. And also, there are so many new millennia has been in the rise of the new money, right? As you know, this whole digitalization has created new wealth, and we are seeing a lot of new era of investors coming on board, really looking into how to use and deploy this capital in a more meaningful way. And we have been very lucky to work with some of those very prominent investors, investing into some of these very exciting technology and energy-related projects. And I think the ESG is really going to be very important and in the asset management sector. So as you can see, Europe is now leading this entire sustainable investment assets management sector. I would think that in the coming months, you will see Asian investors will be taking a lot of emphasis and priorities in also looking into this area of sustainable investment. To take away, I really urge investor looking at STEM investment, putting in a concept of sustainability as well. So social and environment progress for financial investment is very important. And I think while we continue to harness the STEM innovation, we should also incorporate this very important criteria into the areas of STEM investment. We should also take a look at how to invest holistically. We being a family office fund, we have been doing things more from a holistic view. So we participated in philanthropy contribution, right all the way to direct equity investment as well. So we urge more of these investors to come on board to really look at broadening how they invest into innovations. Last but not least, I think all of us should advocate ESG investment. And I think the best thing is to really have a close collaboration with regulators, with financial institutions, how to work together to close the financing gap. Because integrating ESG factor into the STEM investment, in my opinion, is no longer an option, but really a growing imperative. So I hope all of us will have a great event ahead. I like to take away this final word. I think we should really look at sustainable STEM investing because that will really give you more returns optimized. So with that, thank you very much for your time. And I hope all of you will stay safe and will make this world a happy, a safe, and also a more productive world ahead. Thank you.
While companies' access to investors has improved, individual investors continue to struggle with access to the strongest, fastest growing companies within our region. What makes WI Capital unique is our commitment to make a difference in this ecosystem, to find the gaps where we can bring our expertise and know-how in order to assist investors and make an impact in their investment management process. We have created WI Capital for investors to participate confidently in exclusive and scalable investment opportunities. This will be alongside a community of investment professionals. We are committed to nurturing your investments through innovation.
A great keynote to start with Wee Meng leading one of the more prominent family offices in the Asian region.
And I told you he wouldn't disappoint. I know in my intro I talked a lot about him and the sort of long-term relationship that I've had. You know, I said it's guys like him and guys like, you know, Sien Hoi who from SG Innovate that have sort of really helped me understand the potential, you know, not just in Asia, but just across many different sectors. So I said really happy to have them involved in STEM.
Absolutely. And day two is quite exciting as well because our first segment is energy and clean tech, which we know we have an untold amount of companies that have come to us in that space.
Well, we've been very fortunate enough to have a lot of renewable energy tech companies. And the obvious reason is, and it's been talked about very publicly from some of the top investors globally, in that there's trillions of dollars of infrastructure sitting in the energy space. And you know, that is currently being disrupted. You're seeing things like where solar energy and wind and renewable energy becoming now cheaper than traditional energy. And for me, that's what creates the economics that really create the opportunity. And you've got investors like Kathy Wood from ARC who's been talking about and helping sort of give education around how Wright's Law and the consistent growth and manufacturing output in this space is now making these technologies a lot cheaper, that it suddenly becomes logical. So that conversation before of, you know, should we invest into it or should we not, is now not really there anymore because it is now cheaper.
Absolutely.
And in that, once again, it creates exactly the whole theme of what we've talked about. It's an exponential opportunity for investors because that whole entire space is being disrupted.
Absolutely.
And that outdated infrastructure now is looking for a new home and looking for new opportunities attached to it.
Well, that outdated infrastructure now, in that it's being updated and it is moving the whole ecosystem along with it, is now opening that option, like you said, for scalable energy solutions.
And it creates new products as well. Like I said, there'll be financial products from it. You're seeing companies, you know, where they're, you know, utilizing blockchain when it comes to energy. There's lots of creativity that's happening in that space. As far as what it looks like 5 to 10 years from now, who exactly knows the exact makeup, but it's incredible to see the amount of energy and innovation coming in the space, because it naturally leads to what people have been talking about, the decarbonisation, by 2050.
Absolutely, and this topic is obviously at the forefront of venture capital consciousness at the moment. They're all looking at these sort of opportunities. So to start, we have 7 opportunities presenting now, and we'll check back with you right after they're done.
Hello, my name's David Speller, and I'm the CEO and founder of Optifarm. And for the next few minutes, I'd like to take you through what we're doing here at Optifarm. So Optifarm is a pioneering smart farming service that provides software as a solution, management support, driving new levels of productivity and animal welfare together. Our business case is based on a number of favourable indicators. The current production approach has structural and operational inefficiencies built into it. We have early commercial activity in 14 countries around the world with 30 paying customers to date. We're highly scalable and have a subscription and data consultancy business model. And I've built an experienced business team with poultry analysts and award-winning broiler farming knowledge here at Optifarm. To date, we've raised 1.3 million in sterling in investment, and we're building formal agreements with global brands, which is a really key way for us to access strong markets. So the current sector pain point, so we understand this, is that livestock production facilities are only really monitored when staff are on shift. Existing digital solutions deliver data, dashboards, graphs, but they don't explore why something's happening or give any advice how to make it better. Livestock workers are not data analysts, and they don't want to be data analysts. Sector experts cannot be in all locations at all times. And up till now, no one else has ever recorded why things happen. And that's really important when you want to understand how to make things better going forward. So when we combine all this together, there's no systematic way of driving production efficiency or animal welfare standards based on previous experience. And that's key. That's what farming's all about. Take your learnings forward with you for better production tomorrow. So the solution we have is unique, but actually quite simple. We have continual assessments by humans and artificial intelligence of what's happening at farm level. We then look into anything that's not optimal and start to discover what's going on and why. We learn and understand the root causes of these problems. And then we share our findings and advice with our clients so that they can make changes and make things better. And then we capture everything we saw and everything we learned and all the outcomes in a database to then enable us to have better assessments and advice as we move forward. It's simple, but it's actually globally unique. To date, we've got some fantastic case study data that have shown how productivity gains are made, predominantly by reducing stress levels in the animals and making their environments more comfortable. And we have lots of data and examples to show how we capture everything that we're seeing in a database that can then be analyzed by machine learning. Our current traction is generating increasing global reoccurring revenues, and that's really important. And the blue line here is showing how in the last months, as we come out of COVID now, that's really escalating very rapidly. And here are some maps that show you how strong we are in the UK, Europe, but also global. And actually Australia, one of the furthest customers, was our first and our remaining customer from a few years ago. We're quite strong in that region. To date, it's 14 countries, 8 different languages, 9 different time zones. And we have these commercial arrangements with these brands, Evonik, Big Dutchman, Scove, big brands in our sector in nutrition and in the equipment supplies. And we're building other similar global brand relationships. If we look at the market and the growth that's out there at the moment, here's a couple of graphs showing on the left how numbers and tons of protein from animals is growing and due to continue to grow. And in the bottom right, we see data that forecasts that software as a service is growing in this sector as well. And that's where our forecast comes in, matching these trends. And to date, we are on the path that matches our forecast. I have an experienced team here at Optifarm, headed up by myself as a CEO, with Mark Redshaw from Evonik Venture Capital on my board with me, and Tim as a non-exec director. And in my management team, I've built a very competent team working with the finance, technical, commercial, and operations. And these guys are firmly in place and taking us forward. So the funding round we're looking at is 500,000 in sterling, and predominantly this money we're going to use for developing further artificial intelligence, which will make our service better, exploiting machine learning capabilities, and we're working with Microsoft and their innovation team to do this because that's key to new learning, but then also looking at new products and new sectors, and we're in early discussions to enter new species. So today we're in poultry, but we're in discussions to enter into pigs, aqua, dairy, and other sectors in the future. And that's why we're raising funds. So in summary, Optifarm is offering you an opportunity to invest in the growth of a unique AI-driven software as a service management support service as we continue to go global. The business is capitalizing on global trends that we're all seeing in agriculture and also in technology deployment. We have a proven business model with initial reoccurring revenues and a clear development path of how we scale and grow in the future. And finally, Optifarm has the technology and the team in place to achieve all of these growth plans today. We are here, we're established, and we're ready to grow. Thank you very much. And if this is of interest, please reach out. Here's my contact details, and I'd love to talk more detail with you.
Hi to all the wholesale investors currently watching. Now I'm going to try to keep this presentation to about 7 minutes. The structure of the presentation will be as follows. I'll introduce myself, the problem, the industry solution, our unique solution, and then I'll go through some of our awards and grants along with our future plans. So first off, an introduction. My name is John Shannon. I'm the CEO and co-founder here at Post-Harvest Technologies. I love this job, but I've not always had this job. Straight out of high school, I jumped into the New Zealand military. From there, I went on to start 3 tech companies, one which was PushPay, a SaaS model company, which has now gone on to be worth over $1 billion US. So that is a little bit about me. Now, straight on to the problem. It is an industry known fact that over 45% of all fresh produce is lost or wasted each year on the journey from the farm to the customer. That's around 1.3 billion tonnes of unused food, which is valued at over 700 billion in losses each and every year. That astronomical amount of produce not reaching the end customer will sadly be thrown into the ocean or stuffed into landfills. That accumulated methane and carbon release from that waste contributes to a larger carbon footprint than the entire airline industry. And if that problem wasn't big enough already, according to the UN, our global population is forecasted to reach over 10 billion by 2050, meaning that we need to double our food output in an industry which is already straining in all of its resources. So while doubling down on food production isn't on the cards, there clearly seems to be here an opportunity for the industry to be better stewards of all the resources we currently do have. The largest and longest stage of the food supply journey for fresh produce is with inside storage. And in some particular cases, particular foods can be stored up to 18 months. With inside these storage periods, over-ripening of fruit and vegetables is by far the largest problem and the biggest reason for waste. Which leads me on to current industry solutions. The industry solutions to this problem right up until now have been very poor. In fact, most of it can be summed up in basic guesswork. The most accurate industry solution to this point has been a gas chromatography machine. This is used to measure ethylene, the organic compound which was released through ripening produce. Now, while it may be the most accurate monitoring method, industry standard GC units cost upwards of $100,000, require scientific qualified personnel to operate, and unfortunately in many cases take weeks to get results back, rendering these results useless as rotten produce can affect surrounding produce in as little as 3 hours. Which leads me on to our solution. So the team at Post Harvest wondered, what if we could create a device which excels in all the areas that the GC unit falls short in? The idea has taken us over 4 years, millions of dollars, expert team, but I believe we've accomplished what we set out to achieve in our stage 1. We've created a multi-sensor device which can consistently capture atmospheric samples in order to read ripening contributors such as carbon dioxide, ethylene, temperature, humidity, and many other factors. These readings are then pushed instantly to a user-friendly software so that key personnel can look at it and determine exactly what they need to do 24/7. The sensitivity of our product can allow for predictive readings up to 9 months in advance. This level of forecasting has simply not been seen in this industry right up until now, and this can equip decision makers with the knowledge necessary to send out shipments in very optimal times, knowing that every crate will reach its final destination in a healthy way. This device has the capability of saving the industry hundreds of billions of dollars each and every year, yet our pricing model is a lease model at $8 per day, which will pay itself off almost instantly. This technology is going to change the entire industry. It's going to prevent huge industry losses. It's going to reduce carbon emissions. It's going to increase outgoing supplies, and the industry has already begun to take large notice. Awards and grants. Since launching our prototype and conducting university trials, post-harvest have won innovation awards across a number of different categories, as you can see here. We've also been featured on Behind the Scenes with Lawrence Fishburne, airing on such networks as CNN, Fox News, and CNBC. Now, while winning such awards and recognitions, we've also been awarded multiple grants and tax incentives for our work in the field, which covers large portions of expenditure in categories such as research and development, commercialization, and international promotion. We currently have 30 major strategic clients wanting trial to buy units, representing over 500,000 potential sales at $8 a day. A lot of these names are household names and local supermarkets that you may know. Last month, we had the largest North American reseller and distributor with Inside AgTech wanting to on-sell our devices on a commission basis as well. This leads me on to our future plans and projects. We currently have around 20 investors on board, ranging from family members to professional investors, including myself, which has put down over $1 million on the project so far. This is actually the first time we've done something like this, where we're opening it up to people outside of our immediate circle, and most likely will be the last time we do a major raise like this one. We have expression of interest since opening it up from multiple people and VC firms, including a couple of firms that are watching right now. Hello to you. And I'm pleased to announce that as of today, we are currently committed to raising $1.5 million. These funds will be matched with our other grants and our other funds, totaling in over $3 million. And over 86% of the total funds will go directly into manufacturing and installation of our first 1,000 units, which have already been requested. The funds we make back from this initial batch will very quickly pay themselves off and allow us enough funds to build our next 10,000 units and then our next 100,000 units and so on and so forth. Our mission ultimately is to work with the top 100 organizations within our field, which represent nearly 80% of the entire industry and millions of call rooms globally. If we can work inside each one of those ones, it will make a significant impact to the global food supply and reduce carbon significantly. In summary, we have a very unique and multi-patented device in a sector which is rapidly growing, a world-class engineering team which specializes in gas calibration, micromeasurements, algorithms, and has a proven track record on 3 multi-billion-dollar companies. We have a large market desire, interest from household names, proven distribution channel, multiple grants, industry awards, and sophisticated investors on board. Now, if you're interested in being part of the journey with us, I'd very much like to have a phone call with you and go through any questions you may have. Wholesale investors, thank you for your time, thank you for your attention, and thank you for your interest in solving a global problem. Cheers.
My name is Stein, I'm CEO of Advent. Just a bit of background, I've been in the infrastructure development environment for 30 years, mostly in complex infrastructure, power generation, and worked across Africa, Middle East, Australia, and New Zealand.
Hi, I'm Christian Strauss. I'm the COO of Advent Energy. I have 20 plus years of experience in the energy infrastructure space and also subsequently civil infrastructure space as well.
What is the problem that we're facing in terms of the Australian electricity grid? If you look at the current markets, everything is centralized, it's very traditional and it's fixed, whereas we're moving towards decentralized, renewable and flexible. The problem we're facing is grid instability, grid congestion, volatile markets, and obviously physical limitations, but there are solutions in terms of smart grid, intelligent markets, and we are looking towards flexibility.
When you look at where we've come from, large coal-fired generation that sends power one way to major capital cities through a transmission network that is basically one directional to focus on sending power to end consumers in cities. What we're looking at in the future on the right-hand side is a diversification of that. Renewables will be located in many spots around the country, need to be connected through a diverse smart energy network that's bi-directional and can send energy to existing and new consumers of the future.
So what are the challenges we're looking at? Existing infrastructure is not renewable ready. There are limitations in terms of the transmission networks. There are significant delays and curtailment happening in those networks. Then there are the issue of regulatory red tape in terms of becoming a regulated asset. The vulnerability of the network is a further aspect that needs to be considered because the network has got no backup and it's not connected to something else. And getting connections is a very highly complicated and expensive exercise going forward.
So what's our value proposition? Our value proposition is connecting the best renewable energy sources from around the country. As you can see on our map there, mainly they are located outside the existing network, which hugs the eastern coastline of Australia. So Central Australia, the Great Australian Bight, Western Australia, and the Northern Territory. Connecting those and sending diversified renewable energy from across the country will help assist in the acceleration take-up of renewable energy and the phase out of coal.
So I would ADET assist in resolving this. Obviously, looking at the current energy demand, you need to transport the energy from point A to point B. You need to look at the grid stability issues, and you need to find a way to actually deal with the trading of renewable energy capacity. Also, ADET would be looking at the federal budget setting aside for potential investment in the renewable side. Further to that, also look at the enablement of renewable energy from across the country, enhance long-term profitability of operations, in other words, changing the issue of curtailment, and very importantly, to support the enhancement of hydrogen, wind, and solar portfolios going forward.
So what's the solution and what will it bring about? Well, the solution is high voltage direct current transmission. It's much more efficient, it's cheaper, it eliminates curtailment and marginal loss factors for renewable energy generators. It's an expansion of the existing network and actually helps in assisting the existing network in becoming stronger and more effective in its energy transmission. It'll unlock vast renewable energy zones and reduce the time for those renewable energy providers to come to market.
So what is the competition for ADET? ADET, looking at ADET in its sense, it's fast, it's continent wide, it brings significant benefits for Australia. It is private network or merchant network, whereas existing regulated transmission networks are slow, it's regional. They obviously would protect the existing current installed base, and it's pretty inflexible in terms of that. Then you have private or oil and gas transmission and other distribution companies that are not really focused on renewable energies. They provide single connectors, and there's a particular conflict of interest. Most important of all of this is ADET would add value to all those networks and unlocking more transmission capacity.
So why is the timing right now? Well, the major risk to new renewable energy providers is connection. Getting a connection into the network takes time and money and is very troublesome for the energy developers. With recent other developments such as bushfire and COVID, large institutional investors are now heavily pushing for a renewables-led economic recovery post-COVID.
So we've been in discussions as ADET with a number of strategic partners. On the OEM side, General Electric, Siemens, and ABB are extremely supportive of the way forward in terms of the new network. On the financing side, we've been really working closely with ANZ Bank, having discussions with Macquarie and Deutsche Bank. On the regulator side, AMIO has clearly expressed their support for the project, and we've also been working closely with Northern Territory. There are other players like CIP and QIC. There are technical players such as TSK, ZTT, and then there are private equity firms. Private equity firms like to jump on, but they can only do that once we achieve financial investment decision. And then obviously there's a number of renewable energy developers that would like to become part of this as well.
So what do the figures look like from a high level down? So from our concept level network that we've developed and done some study on, we're looking at 5,000 kilometers of transmission network with a capacity of about 10 gigawatts, enabling about 20 to 30 gigawatts worth of renewable energy development to go forward. Development funding, we're looking for 10 million the first year and 15 million for subsequent years 2 to 5 to fund our operations, which will involve engineering design, stakeholder engagement for government regulatory issues, and dealing with renewable energy developers. Going forward, post-financial close, final investment decision, we're looking at, in a base case scenario, a capex investment of $10.5 billion, an IRR of 12 to 15%, an NPV after tax of 5.2 billion, and an EBITDA in our base case of 1.8 billion.
So what's next for the investors? As Christian was saying, is we would be using the funds mostly to look at the feasibility, continue the creation of intellectual property, develop the necessary algorithms around our energy arbitrage, look at the initial stage development activities, and build our models. So as said, our initial ask is 10 million for the investment. We would be looking at further grant funding as well as we move forward. The step up for the initial investors would be around 6 times over that set period. Thank you. Connect with us on the CRISP network.
Hi and welcome to Solar Cloud. I'm John Kennedy. Traditionally, we buy solar to reduce our energy costs. With Solar Cloud, you still buy solar, it still reduces your energy costs, but this time, the panels are just not on your roof. We all know solar is not only good for the environment, but saves us money on our energy bills. But so many people cannot benefit from solar. Some people live in apartments, some people's roof faces the wrong direction or is made of the wrong material, and the average Australian moves every 7.2 years. Or it's the upfront cost that gets in the way for a lot of people. The Solar Cloud solution is simple. You can pick up any mobile connected device, including your smartphone, and purchase as little or as many Solar Cloud panels as you wish. This directly credits your energy bill and reduces that bill. This enables anyone, anywhere, to own and benefit from solar without even needing a roof. How do we do this? We quite simply manage your investment in solar for you. You purchase panels, we sell the electricity generated by your panels because we place them on commercial buildings, and those funds are transferred directly to your energy account. It does not matter whether that energy account is made up of connection charges, just simple kilowatt charges, or even your gas bill might be on the same account. Solar Cloud pays whatever bill you enter in the dashboard of the Solar Cloud website. You can live anywhere you wish. You could, for example, be living in minus 30 degrees, under 3 foot of snow, pick up your smartphone, buy panels located in Australia that pays off your bill in the snow. We manage it all for you. Maintenance, insurance, monitoring, 24/7. You can live in an apartment, you can own an electric vehicle and have the whole thing paid from your Solar Cloud virtual panel investment. As mentioned, those virtual panels are actually located on commercial buildings. Why will the commercial building entertain this? These are called power purchase agreements. They are very, very popular globally. In fact, in 2019 alone, there was $4.9 billion worth of PPAs done in the United States alone. In Australia, these are becoming more and more popular, not just for large businesses, but also smaller entities. Why does the business want to do a PPA? They have no capital expenditure and they still have solar on their roof. They have no operational expenditure. They can monitor and maintain it 24/7 through our app, and they get the green tick without, as I said, any operational or capital expenditure at all. While the concept of Solar Cloud sounds so easy, we have taken almost 6 years in research and development to get us to this stage. That includes testing the market, placing a small ad on Facebook to check for product market fit, and we have over 5,000 registrants waiting to purchase. We have now also completed Australia's first product disclosure statement for buying virtual solar. We have a registered ASIC investment scheme. Those details are all available on our website, and the PDS is available on every single page of the website. We have conducted a test site, and that test site has been up for more than 12 months and immediately sold out within 48 hours without us publicising. And in fact, the average order value was over 5,700 Australian dollars per person. The Solar Cloud Group is broken up into 4 different companies. One is obviously the virtual solar, which is under the brand Solar Cloud. Another is the Ligero business, which has been profitable now for 4 years. We also have Just Commercial Energy, which is the brand we use to put the panels on the roofs of commercial businesses under PPAs. We also have thegreeninvestor.com. This business sells essentially the same product as Solar Cloud, but is in a different language, as this is talking to the wholesale and investor market, where we talk to them about yields, investment, and return in a green energy product. We don't talk to them about saving energy. We don't talk to them about reducing your bill. This is purely, how much is my investment? What will I get in return? What is the yield? What is the interest? What is my liquidity, etc. At Solar Cloud, we see a huge expansion opportunity overseas, not just from the customer's point of view, as they could be located in Alaska or Greenland or anywhere in a harsh climate and own panels here in Australia that pay off their bill at home. But we also are expanding with JV opportunities at this current time in India and also in Europe. As outlined, we have proved there's a pent-up demand for Solar Cloud virtual panels. With this fundraising of 2.5 million Australian dollars, we will be using our brand of Just Commercial Energy to get as many panels on commercial rooftops as possible. We will be doing this via power purchase agreements, and also some of the investors' funds will go towards patent and legal protection for our system. Solar Cloud has gathered together a great team of lawyers, accountants, IT people, marketing people, and also people with genuine solar experience. We are all happy to talk to you. Whenever you have any questions at all, please feel free to reach out. To date, we have raised a little over 1.1 million Australian dollars to get us to this stage. We are now raising, as mentioned, 2.5 million Australian dollars as expansion capital into the Australian market and to complete at least 2 of the joint ventures in current negotiation. Once these are complete, we will look at raising further capital for global expansion. In summary, we all know climate change is a hot topic right now, not just here in Australia, but globally. At Solar Cloud, we have created a simple to use platform that enables anybody, anywhere to benefit from solar. You can now live in an apartment, be a renter, have a roof that faces the wrong direction. You can move locally, interstate, or overseas and still own solar. While we've done this and it's easy to do for the customer, it is a very complex back end. Putting together not just financial licensing and compliance and regulation, but also energy compliance and regulation, and making it all easy to use for the customer. We're moving forward to make the global $4.5 trillion a year energy market greener. I'm John Kennedy, this is Solar Cloud, and I thank you for your time. Please contact me, john@solarcloud.com.au.
Good afternoon, everyone. My name is Jerry Kominos. I'm the CEO of a company called Hydrolight International. I'm delighted this afternoon to be able to present you with an overview of the business and the technology that we have developed. So Hydrolight has developed a water-activated battery fuel cell. Let's think of a disposable battery, primary source battery that gets used in a radio, a lantern, and any other application that uses a battery. We believe by developing this and commercializing this technology, we'll make a real difference to the world and people's lives as an alternative to disposable batteries. We believe we are very close to releasing a clean tech revolution on the world, which will aid and deliver on the United Nations One Earth policy. So the problem. Basically, the problem is 15 billion batteries get manufactured every year, and the vast majority of those end up in landfill. We know that batteries are full of toxins and poisons, and having them in landfill creates a massive issue from a sustainability perspective. Depending on where you are in the world, anywhere between only between 0 and 20% of batteries get recycled. So we have a massive problem with batteries ending up in landfills. The solution is effectively a hydrocell, which is a clean, green, water-activated fuel cell, which is recyclable and biodegradable. So as the hydrocell consumes the internal magnesium and other natural minerals within the cell, it eventually ends up as being a recyclable battery. The main characteristics of the cell is it's got an infinite shelf life, so nothing happens to that cell until you activate it in water, so it retains 100% of the power capacity that it has today. The hydrocell delivers significantly more power than a traditional battery and or other forms of carbon energy like kerosene and diesel. And most importantly, as I've discussed, it's environmentally friendly. In terms of the addressable market, we've developed our own torch range and proprietary fuel cells that you can see on the left-hand side. We play in a torch market of $8.2 billion. We are developing, as we continue to innovate the hydrocell, we're developing battery substitutes in the form of DC and 6-volt batteries, and then in second phase, AA and AAA batteries. And then we'll be playing in a $30 billion addressable market. We're in the process of manufacture at the moment, manufacturing 400,000 finished product units. We have significant traction and interest and commitments from retailers around the world, predominantly in Australia and the USA. Those brand names that you can see on the screen have all provided commitments that as soon as we land the product in Australia and the USA, they'll start making orders. We have worked through strategic launch campaigns with many of those brands, and are confident that in calendar year 22, we'll generate significant traction from those retailers. Just take a step back. So from an investment perspective and overall position, we have a clean technology which is ready for commercialization. It is globally disruptive and will positively impact on the world. We have full global protection, patent protection over the technology, and the technology is proven. We are fast moving into the commercialization phase with growing commitments from retailers in a large addressable market, and we have no known competitors. From a financial performance perspective, as I said, we're in full production at the moment. The production of those units sold across the world, across our key markets, will deliver us 80 to 90% of that revenue forecast for FY22. We obviously have a significant growth profile from a revenue perspective, but we believe that's attainable given the disruptive nature of the technology. From a team perspective, we have a really powerful executive team around the business. I've been in the business for about 2 years. Previously was the CEO of a company called RMS, which is one of the global reservation and channel management software businesses. I managed that business for 4 years, doubled the size of that business, and was brought across by the owner of that business to help commercialize Hydrolite. Tim, who really looks after the commercial and strategic aspects of the business, has significant experience with McKinsey and has grown businesses and run businesses in his own right. Chris O'Neill, likewise, recently sales director of Stanley Black & Decker, brings significant relationships across the retailers in Australia and the US, but also significant relationships across many other original equipment manufacturers in the toy industry and power industry that we're talking with. And Mark Dancy and Brian Dunster are part of the original team that founded the technology, but are very much involved in the overall management of the business. We have a high-profile board that is well invested in the business. All are either owners of their own businesses or have successfully run and grown their own businesses and exited their own businesses. From an investment perspective, we're looking to raise about $5 million. $1 million is committed by a major shareholder who is one of the non-executive directors and has been funding the business for the last 24 months. We believe that we can move very quickly to an investment realization event with revenue momentum, and we believe we can deliver a premium exit with this disruptive technology. From a capital structure perspective, we are a public unlisted Australian company. All our capital is through shares, so there's no loans or debt commitments in the business. Our major shareholder owns 47% of the business, and the directors and management team are well invested in the business and the outcome of the business. From a utilization of funds perspective, all our capital utilization is forward-looking. We've proven the technology and we've completed the R&D phase. Our utilization of funds is all forward-looking. So it's about production and sales, marketing, and continuing to bolster the team to deliver growth and to deliver an exit for investors. So I trust that's given you a quick overview of the business and the technology and where we believe we can take this. And I thank you for your time.
Hello, I'm Jeff Andrews, Chair of Capricorn Power. There's a big problem. Electricity is essential to our modern society, but 61% of the world's electricity is still generated from climate-destroying coal, gas, and oil. Now, nearly every country in the world has committed to replacing that fossil fuel electricity. That's a huge challenge and a huge market opportunity. The global opportunity is roughly $5 trillion in equipment replacement alone. Project and operating revenues will be much, much higher. What's our solution to this global problem? Capricorn Power has a unique, patent-protected thermodynamic cycle, or method of converting heat to electricity. The main advantages of our thermodynamic cycle are high efficiency, so we'll be able to generate more electricity from the same energy input. Maintaining that high efficiency, even at low scale, so we can deploy anywhere. And the use of an external heat source, so we can use a wide variety of energy sources. With these advantages, we plan to deploy our heat engines, or mini power stations, to where the electricity customers and energy are. Imagine up to 1 megawatt of renewable electricity generation in a shipping container, in communities, factories, and waste stations everywhere. Clean, quiet, efficient, climate-friendly, and cost-effective. This is called distributed energy. Distributed energy has many advantages over large, centralized industrial-scale electricity generation. We plan to disrupt that centralized power paradigm. Higher efficiency results from eliminating transmission energy losses, estimated by the International Energy Agency to be as high as 18% in some regions. And by combining electricity and heating applications, we can achieve overall efficiencies approaching 90%, compared with 30 to 60% in most centralized power stations. By eliminating network costs, which are up to 2/3 of total electricity costs, we can also charge more for electricity and still save customers money. Small scale and being close to the energy source means we save on fuel transport as well. Communities can own their own power station, both figuratively and literally. Containerized power plants will blend into the communities and landscapes rather than dominating and distracting from those landscapes. We can use any heat source above 300 degrees, for example, biogas flares, exothermic chemical reactions, furnace flues, and even the exhausts of large internal combustion engines. This wide variety of applications has led to us receiving unsolicited approaches from potential partners and investors with strategic interests in those sectors, including companies and industry associations in recycling, waste processing, power generation, food processing, timber, solar thermal companies, and governments. Our worldwide mission is to replace coal and gas plants. But where do we start? Our beachhead market is green waste to energy because we solve the 5 problems listed on this slide. We'll divert green waste from landfill, generating green electricity and green heat. And there is the commercial benefit of earning revenue from biochar and revenue from green certificates for the electricity, the heat, the biochar, and avoiding landfill. We're also highly motivated by the potential of our technology and our business plans to make a significant contribution to 7 of the United Nations Sustainable Development Goals in the areas of affordable clean energy, decent work and economic growth, industry, innovation and infrastructure, sustainable cities and communities, responsible consumption and production, and a big contribution to climate change and to life on land. We have an experienced management and engineering team leveraged by specialist contractors and a board of directors with extensive experience in startups, commercialization, the energy sector, and government. Timing is important, and now is the right time, with strong tailwinds which haven't existed until recently, with almost universal commitment to climate action, growing demand for electricity, and communities wanting a circular economy and a sustainable environment. Capricorn Power's innovations have been widely recognised, and here are just 9 examples of that recognition. Recently, we were also named as one of the top 5 global waste-to-energy startups from a field of 146 companies which were analysed. In August, we received a notice of allowance from the US Patent Office, which means we can be issued with a US patent, probably one of the most difficult jurisdictions in the world to do so. And this bodes well for the other 20-odd countries which we have applied to. Also in August, the Australian Securities and Investment Commission promulgated Capricorn Power becoming an unlisted public company, paving the way to limited volume share trading when the time is right. In summary, we have a unique technology which can help to solve one of the world's most pressing problems, climate change, while achieving multiple additional benefits, which are commercial, communal, and environmental. We've achieved early traction with manufacturing and go-to-market partners. Our recurring revenue model is designed to maximise the benefits of this trillion-dollar market opportunity. Our IP protection includes a pending patent with more to come, designs and trade secrets, and a worldwide license for a key component and strategic partnerships. The investment opportunity. In this round, we have raised $1 million already through a crowdsourced funding campaign and follow-on high net worth investors. And we have $2 million to complete the round and to achieve all our goals. Our potential market is very large and we have a strong IP moat. And we're about to complete our demonstration engine, which we expect will create significant commercial, government and public interest. The pre-money valuation is well below that of comparable clean tech companies at a similar stage, and would be happy to share those comparisons with you. We will use the funds raised to complete the demonstration engine soon and to achieve a technical readiness level of 9 by running the engine for its first 1,000 hours. We'll also use the funds to scale up to 150 kilowatts or greater and to build and operate the Geelong bioenergy and biochar commercial project and to grow the engineering and commercial team. To conclude, we're standing on the cusp of a renewable energy revolution. We aim to generate renewable energy efficiently, locally, 24/7 using free heat and free waste. And this will complement intermittent solar and wind. Together, we have the power to change the world. I hope that you can join us on this exciting and profitable journey ahead. Thank you.
Welcome to all. Your time today is much appreciated. My name is John Fletcher and I'm the Executive Chairman of Green Distillation Technologies, GDT. We're an Australian company that has developed and proven a proprietary process to convert end-of-life tyres into 3 saleable commodities of carbon, oil and steel. The problem of waste tyres is huge, with 1.7 billion generated globally each year. In Australia, there is 26 million waste car and truck tyres every year. This photo represents the size of the problem, and it begins when the original set of tyres on your car need replacing. Where do they go? The construction of new car and truck tyres is necessarily very robust. These characteristics make tyres quite difficult to deal with as a waste product. They take around 300 years to biodegrade if deposited in a landfill. In fact, in 2020, Tyre Stewardship Australia estimated that 71% of all waste car and truck tyres were exported, predominantly to Asia and India. You heard right, 71% of Australia's waste tyres were exported to someone else. A further 11% were either dumped, stockpiled, or landfilled. As a country, we need to do better, and we can. There are 3 factors converging now which will provide the impetus to do better. First, the irreversible world focus on green, on renewables, on recycling, and on the circular economy. There is no turning back from this. Secondly, the Australian government has legislated to ban the export of waste such as plastic, glass, paper, and tyres. A recognition that modern developed countries should be responsible for their own waste streams. In the case of tyres, the ban becomes effective from December 2021. Thirdly, the GDT technology is proven and commercialised to process waste tyres with an operational plant in New South Wales currently being expanded. A second plant is permitted and shovel ready at Toowoomba in Queensland. So what is the GDT solution? The destructive distillation process was developed by an Australian, Dennis Randall. It's unique, and GDT became the first Australian company to receive an award in innovation at the prestigious Edison Awards in the US. Let me play a 1-minute vision which shows how the process works.
The GDTC recycling process, destructive distillation, is unique and highly effective in recovering wasted resources and delivering high-demand valuable raw materials. The process is emission-free with a small amount of the recycled oil used as the heat source for the operation. The process begins by conveying whole ELTs into a loading chamber, which is sealed and evacuated of air. There is no requirement for any additional pre-processing of the tires, such as shredding or crumbing. With the heat acting as a catalyst for the chemical reaction, the tires are deconstructed into their basic atomic components. Some of these recombine into various new compounds, from which the lighter vapors are extracted and condensed into a manufactured oil. As the chemical reaction comes to an end, the carbon in steel is extracted, cooled, and separated. These deliverables are of good quality and are often used as raw materials by industries, including the rubber and tire industries as raw materials for their production processes. Importantly, the GDTC solution is highly profitable with no government or industry subsidies required, has a negative carbon footprint, and has no harmful emissions.
The Australian market generates around 350,000 tonnes of waste car and truck tyres every year. Each GDT plant will process between 5 to 6% of those tonnages. So with 7 plants expected for Australia, this would see just 38% of the disposal market captured. Importantly, we do not see ourselves as disruptors to the existing tyre collection segment. Our role is to provide an efficient and profitable disposal option. The federal government ban in December will see the doubling of volumes to be processed here in Australia. The capacity to cater for these volumes does not currently exist. Market competitors offering disposal are primarily focused on crumbing the tyres to be used in applications such as playground surfaces, pathways, as well as an ingredient in road surfacing. The markets in Australia for these applications are limited. Our business model is to build the 7 plants. We will charge a disposal fee for tyres delivered to our gate at prices comparable to what collectors are already paying. At the completion of our process, we're left with 3 commodities for which we will also receive revenues. These commodities are carbon, which represent 47% of the output, the most widely used industrial chemical in the world. Recovered carbon black is now much sought after worldwide. We see carbon as our sleeping giant with significant revenue upside. Oil represents 33% of the output. The GDT oil is a mixed hydrocarbon and can therefore be refined into various fuel fractions. Our business cases included oil revenues at the market price quoted by international traders today. We expect to achieve higher prices from local buyers when regular deliveries in volume are achieved. Steel is the 3rd commodity and represents 20% of the output. Steel recycling is an established global industry, and the steel from our process comes out clean and is in high demand due to its quality. The business case assumes local market scrap steel prices. The combination of revenue from the disposal fees added to the sale of the 3 offtake commodities results in very attractive financials. The annual revenue per plant is $12 million, with the plant operating 24/7 for 329 days a year. The EBITDA generated is in excess of $8 million. This provides an after-tax payback on capex invested of between 2 and 3 years. Our team have been together now for several years preparing for this rollout phase. There is a good mix of corporate, financial, and technical experience in this group. Following the capital raising, there'll be further additions made to the team to manage the growth phase. What is our ask? We're seeking to raise $12.5 million, of which $2.5 million is in the form of convertible notes with a 10% coupon and interest paid quarterly. These notes come with a 30% discount to the price to be offered at the IPO. The balance of $10 million is in equity. So in conclusion, GDT represents a viable and environmentally responsible solution to a waste problem that's been such since the tyre was invented 120 years ago. Converging events make for a compelling investment case. The business operates with a negative carbon footprint. The capital raised will see the expansion of the first plant in New South Wales and the commencement of the second at Toowoomba. A final capital raising, probably via an IPO, is planned for late 2022. And yes, there are opportunities to take our technology overseas where similar problems do exist. Discussions are already underway with parties in the US, UK, and Europe. Our focus, though, is to have 2 plants operating in Australia as our first step. Your participation can help make this happen. Thank you again for your time, and please feel free to reach out for further information.
Those were exciting 7 investment opportunities. And just before we go on to the commentary for the next session, if anybody did want to reach out to a founder of any of those opportunities I had just presented, you can do so via the Brella platform, where you can book a one-on-one meeting, and you can also request access to their deal rooms via CRISP. Now, the next series of investment opportunities are an array in terms of sectors, right? I know there's one in there that you're quite familiar with.
Well, look, we're basically covering things. Obviously, telco has been a sector which has really grown over the last sort of 20 to 30 years, and there's still new innovations, new opportunities being created. The other one I think is really quite interesting is City Zenith, where they're looking at digital twins, and their highlight, what they're focused on is how do you create real-world structures to allow the design and then the development of sort of low-carbon cities, buildings, and infrastructure, which is obviously very, very prominent in design and development thinking for buildings globally.
And I don't know about you, but I think everybody is very data conscious at the moment in terms of privacy with their data. And this is why Vista excites me, which is a Gary Vee backed business.
Which is always unique, right? Like, how often do you have the opportunity to invest alongside someone like Gary Vee, who's so prominent in the actual media space? And also what's interesting about Vista is there's a blockchain element to it, and there's a data ownership element to it. And if you think about if you look at the way investment trends take place, the last 10 years, we've effectively given our data to big tech companies and allowed them to on-sell that data. Whereas what Vista is looking at is how do you take back ownership of that data, and then how can that be utilized for your ordering, for your sort of personalization of what you're looking to buy. So whether it be your day-to-day life, whether it be coffee and so forth, I just think it provides a really interesting perspective on what's going forward, and that the blockchain element then goes over to what other areas could be, whether it be NFTs, metaverse, etc. So there's some cool different layers that are attached to that. And then looking at other companies like Wing Studio, for example, which is empowering sort of youth employment. And then Brivio, which is that mobility in motion. Obviously, the rise of TikTok, the rise of Instagram has basically turned everyone into sort of content creators. And it's like, how do you simplify that? How do you make it more efficient? And how do you deliver that message faster? So very interesting range of companies across different sectors, sort of as it relates to STEM. And I think quite interesting for investors watching the session.
Absolutely. And so now we'll let you guys enjoy these opportunities presenting to you. And again, feel free to reach out to any of those that pique your interest via Brella or request access to their deal room. Enjoy.
I'm Michael Jansen, City Zenith founder and CEO. For the last 25 years, I have invented technologies that make buildings and infrastructure more efficient, more sustainable, and more profitable. Early investors in my last company multiplied their money 17 times within just a few years, and City Zenith can go much further. We recently signed $4.6 million in new contracts, and were appointed to the World Economic Forum's prestigious Global Innovators Program. So what's all the buzz about? City Zenith's 3D digital twin software platform, SmartWorld, is revolutionizing how major building and infrastructure projects are designed, built, and run. Developed by the chief architects behind Google Earth, SmartWorld makes building professionals 20% more productive, cuts 35% of operating and maintenance costs, and eliminates 50 to 100% of all carbon emissions in buildings of any size, all using one tool. Market sources say the 2020 global digital twin market was worth $3 billion and will rocket to $48 billion by 2026. And we are already recognized as an early market leader today alongside Microsoft, Siemens, and Philips. So what's driving it? A hugely inefficient built environment, costing the world hundreds of billions of dollars every year. Today, 90% of all major projects are behind schedule and over budget, and cities can be blamed for 70% of all global carbon emissions. Smart World is solving such problems, and how we do this is unique in the market. Unlike other digital twin products, it is not a service, but a true software platform that enables customers to easily create their own virtual 3D twins, integrating a vast array of data sets and AI services to solve highly complex problems common in major building projects. Real estate owners, developers, architects, city planners, and major infrastructure operators love the scalability, user-friendliness, and out-of-the-box integrations with existing tools. Indeed, this is a great time for the company and a great time for shareholders. We're now targeting a 7 to 10 times return for investors within 3 to 5 years. Or even earlier thanks to a new regulated secondary trading platform. We're on a mission to eliminate carbon in cities around the world, one building at a time. Please visit cityzenith.com and click on Invest to find out how to join our investor community and gain real shareholder value. We've recently welcomed 5,000 new investors from over 20 countries, and we welcome you to join us too.
Morning, everybody, and from the UK, and it's great to have this opportunity to talk to you about Faster Fibre, which is a unique company with a highly disruptive technology looking to raise £2 million sterling to support the commercialisation of our processes. In summary, without boring you at this stage, what our processes do is we have developed the ability to extract the inner core from telco and power cables, which is basically the copper, to bring that out so that telcos or power cables can blow super fast broadband in, and we can do that without the need to dig or secure planning permission, which has obvious benefits, which I will come to later. That enables the telco and the power company to realise the value of the copper. You probably know what the value of copper is in the world markets at the moment, to defray the cost of the project. So why did we decide to do this? I think everyone will be aware that one of the most topical things in the economic and social world at the moment is the need to upgrade broadband speed and capacity, with many networks being slow or unable to cope. And if you look at the percentage in countries worldwide of households that have access to super fast broadband, that can be as low as 7%. And in the political and economic agendas, in the UK, for example, the UK government has decreed that by 2025, every network must have a gigabyte capacity. And this is also now part of one of the EU directives. And sadly, or ironically, one of the consequences of the pandemic, with more people home working, online education and streamlining activity, that pressure is only intensifying. So that we know the need is there. What we also know is the size of the global market is massive. And I'll give one example. One of our current key customers at the moment is Vodafone in Germany. Vodafone have a network of 861 million meters, 861 million. So if you take our average pricing would be around 8 to 10 euros a meter, on which we make a margin of 55%, you can understand the size of the market. That is one country alone. So what benefits do we bring to the customer? When we were in discussions with Openreach, who we have trialed for some years ago, they admitted, these are their figures, not mine, that to extract 1 kilometre in a part of London, in South Kensington, cost them all in £2,500 a metre, £2,500. Our delivery cost for our process is circa, on a bad day, depending on the fluid mix, would be no more than 20 euros a metre. Even if you then add back in allowance for our indirect cost, contractor costs, the savings are absolutely huge. We have demonstrated productivity gains when we've been trialing for clients of up to 30%, and cost savings will always run in to millions of dollars, euros, or pounds, and whichever currency we're dealing in. Our process does not require planning because we can go manhole to manhole, or only need to dig a micro pit, so the client can deliver much faster, no need to secure planning permission. And the final benefit is the fluid that we use in one of our processes is totally environmentally friendly, as it's biodegradable. There's no digging, noise. So in terms of disruption and economic benefit and environmental benefit is massive. So where is the company today? Our processes have been recognised by grants from the EU H2020 scheme of 1.66 million euros and UK Innovate, who supported the development of our latest processes, which is drilling. And they actually described it as one of the most innovative processes ready for commercialisation they had ever seen. The process is absolutely unique, easy thing to say, but factually true. There is no other company in the world which offers the process which we do, and we have ensured that our intellectual property is totally protected through patents, and we have those patents fully registered. The market we are working in today, our potential pipeline, which includes national companies, covers Europe, South and North America, the Caribbean, Australia, and India. We have a very strong and balanced management team and a great pipeline. So in summary, where is the business today? We are in a totally unique position with no direct competition. We have run our forecast on only penetrating 1% of the addressable market in the world, which would give us an annual profit in terms of EBITDA, of $10 million. That in turn will enable us to deliver superb returns to our shareholders in terms of dividend return and growth in capital value. It's been a really exciting journey, and I hope you feel able to join us. Thank you.
Hi, my name is Martin Roots and I'm the chairman and founder of the Expeed Group, and I'm talking to you today about Yada Campus, our answer to righting the wrongs that currently exist right across large educational institutions globally. The shocking statistic that one student commits suicide every 4 days highlights the student well-being and mental health crisis facing UK and international universities alike. This is not just a well-being issue, although of course this is important. There's also a financial imperative to fixing this problem. For the UK alone, if a single student drops out of university in their first year, it costs the university £28,000. This means a 6.3% dropout rate costs the average university £9 million per year. Yada Campus is a platform consisting of a student mobile app and a back-end analytics and reporting engine presented via a SaaS model. It aggregates disparate student journey touchpoint data, intelligently profiles disengagement behavior, and automatically intervenes with behavioral nudges in real time. Students use the app to check into class and access their core services and social events, whilst academic, admin, and student support staff use the platform for collaboration, messaging, polling, and data analytics. Yada Campus brings together data aggregation, proprietary algorithms, artificial intelligence, and machine learning to address the problem, allowing real-time analysis of an individual student, providing a comparative measure against their peers, and flagging areas where intervention may be required. The platform also allows the student to see their own progress and helps them proactively to understand where they may need assistance and signpost suggestions of where they can find support. We estimate we can reduce an average university student dropout rate by 10 to 20%, saving them £1 to £2 million a year. Most of the competitors listed here, along with their current market share in the UK, concentrate on a particular area, usually within attendance, academic submissions, or monitoring of a university system's access. Yada Campus is unique in that it encompasses all of these areas and additionally includes social event attendance, the students' utilisation of support services where they've asked for assistance, and the monitoring and analysis of a student's sentiment by directly engaging with the student via the integrated closed messaging platform incorporated within the Yada student mobile app. According to Grand View Research, the global EdTech market is predicted to grow year on year by nearly 20%. And according to Whole and IQ, growth post-COVID is expected to improve on pre-COVID estimations. But estimating the addressable or serviceable markets top-down could only be based on assumptions and would therefore potentially be inaccurate. So let's look from the bottom up. The current market in the UK is serviced by a few companies and their service offerings are roughly broken down into 4 key areas as we've seen previously. These are student engagement, where 53% of UK universities surveyed said they had some sort of monitoring capability deployed. Our market research indicates that they are probably paying around £10 per year per student for that service. 71% have an attendance monitoring solution in place, 46% have learning analytics, 61% have a dedicated student app. Universities that have all of these capabilities are probably paying in the region of £20 per student per year. Yada Campus will provide all of this capability and more with regards to automation, workflow, etc. But to capture market share, we would charge only £10 per student per year, plus an initial setup integration charge of £30,000 for early adopters. In the UK, there are 282 higher education institutions teaching around 2.5 million students. So the total addressable market in the UK is 282 times £30,000, the one-off implementation charge, or £8.4 million, plus £10 for each of the 2.5 million students per year, or £25 million a year. Initially, we'll target those universities without a current capability, i.e. the 47. The global potential outweighs the UK potential significantly. We will first look towards English-speaking countries, or those that teach predominantly in English. According to Statista, outside of the UK, there are 8,055 universities teaching nearly 42 million students in English worldwide. This gives us an addressable market of £242 million one-off, plus £420 million per year based on today's pricing assumptions. This is significantly more if you take on the CAGR expectation of 20%. The rest of the world, some 15,400 universities that teach the remaining 206 million students, would make a tertiary market over time. Alternative markets, such as further education establishments and schools, could expand this potential further, at least doubling it. Activity to date has been centered around research and development. The Expeed Group consists of 4 distinct focused areas, and each has contributed to the development of the Yada Campus concept. We have a great team, many of whom have worked together for many years. Together, we have the skills, experience, and route to market to make this project a success, and would love to have you join us on the journey. In this round, we are looking to raise £1.25 million in exchange for 20% equity in ordinary shares in Expeed IT Solutions Limited, the effective group company. This sets the pre-money valuation of the group at £6.25 million. The funds will be used as depicted here. 500,000 will be used on the next phase of development, taking the platform from proof of concept through to the production-ready MVP. 350,000 will be allocated to the sales and marketing effort, the recruitment of 3 dedicated business development staff, launch campaigns, exhibitions and conferences. 250,000 will be allocated for supporting our expansion with the development of support infrastructure and expansion to other geographic regions, and 150,000 to cover working capital whilst we expand. Should we be able to raise the required capital by the end of the year, then we'll be able to hit the milestones as shown here. We are currently on target to launch our simulator of the platform within the next 6 weeks, and we'll use that simulator to garner feedback from our students and university client user forums. Our YADA Events app, which if you remember will be the basis of the Campus Student app, will be used at our Freshers Festivals in September and October this year to bulk test client onboarding, registration and checking into events. We anticipate more than 20,000 participants at our events in Glasgow and London over 2 days, so this will be a good test of the onboarding process and infrastructure. In the UK, the higher education exhibition and conference season runs from January through to March, and we intend to be production ready for that season with our first iteration MVP. We will take speaking slots wherever feasible to demonstrate the platform and show thought leadership in the student engagement, profiling and intervention space. By April 2022, we expect to have our first conversations with potential early adopters of the platform with a view of onboarding our first client by October next year. The cycle then repeats year on year, but as more clients on board, more will want to join them, and so the pipeline will build, as will the team, the infrastructure, and eventually our target territories. So there you have it. We have the right product to solve a real problem that exists across the higher education sector globally today. We have an experienced, diverse and skilled team dedicated to making this happen with access to the sector and a realistic plan to take advantage of an expanding global market. The ask is realistic, we feel, for a company that is in both revenue and profit and has already embarked on the journey. Investment will increase the pace, and we hope you'll join us. Thank you for taking the time to listen to us today. We welcome questions and feedback and look forward to hearing from you.
My name is Willy Maritz. My partner Peter de Bruyn and I invite you to help us solve the global youth unemployment crisis. Since we have just launched and are still pre-revenue, we are currently raising a round of seed investment. So far, the venture is completely self-funded with cash and sweat equity contributions by the founders of over $200,000. We are raising $550,000 in exchange for convertible notes at a 20% discount against the next raise. So far, we have 2 investors confirmed and are still negotiating the amount they will invest. Our minimum viable product is already developed and was launched on 1 September 2021. We will use the seed money for further development and enhancements, building a core team, and also for marketing and user adoption. By year 5, we project a user base of 10 million users and $20 million profit. According to the World Economic Forum, the global youth unemployment rate has been increasing to over 15%. In some countries like South Africa, that percentage is over 50%. This creates huge social political risks and slows down the global economy at an alarming scale. Governments and global non-government organizations are escalating youth unemployment as a priority and huge amounts of money are currently being allocated to find solutions. A lot is being done at the moment, including educational transformation, youth development programs, workplace readiness programs, employer incentives, and many more. But what's the missing component? Peter and I engaged with employers and asked them, what stops you from employing more young people, considering that their skills are much more affordable? The answer always came down to the same thing. It's too risky. We don't trust what we will get. To solve this credibility part of the problem, we looked at the archaic concept of the CV. The traditional CV or resume does not show evidence of abilities, skills, or attributes, especially not for early career professionals. So we went out and we built Wing.Studio. The Wing.Studio app lets young people build an evidence-based profile using social media style posts to capture all the awesome stuff they do to prepare for the world of work. Young people do cool stuff all the time, from building a rocket in the backyard to helping an uncle in his textile shop, volunteering at a beach cleanup, to mining cryptocurrency, to baking a cake, and even taking online courses. On the Wing.Studio app, we let them capture all of this, just like they would normally capture social media posts. We also prompt them to tell us what they've learned. Then we encourage them to add credibility by inviting somebody to verify the posts, inviting somebody to endorse them, inviting somebody to rate their skills. We use the Skills of the Future framework from the World Economic Forum for this. We take all of this data and aggregate it into a summary profile, showing the richness of their skills and attributes. We can even use this data to dynamically start recommending other opportunities for further development. When they're ready to apply for the job, they simply forward a link to their Wing.Studio profile. From an employer's perspective, this is also about credibility. On a traditional CV, I can claim to be a good player, a good team player with no evidence. But on a Wing.Studio profile, a recruiter can click on team player and see all the posts that make up the evidence for it. So how will we make money? The platform and mobile apps are free to users and free to organizations representing users like schools, universities, colleges, and youth organizations. We aim to build a large-scale user base and then optimize the monetization opportunities. We see 4 revenue streams. Number 1, recruitment. We provide a very strong value proposition to organizations recruiting young people in entry-level roles. Number 2, targeted marketing and advertising. We provide advanced filtering and profiling to target very specific target audiences. We only allow context-relevant and age-appropriate advertising. Number 3 is royalties from value-added partners. Partners like online course providers can showcase their services and products on the platform, and we collect royalties through traditional affiliate marketing links to partners' e-commerce platforms. And the 4th opportunity for revenue is a premium version. A little later in our journey, we will build a premium version with features and incentives and aim to upsell a percentage of our user audience onto the premium subscription. Our projected revenue is, of course, tightly connected to user numbers. There are over 1.8 billion young people in the world today, 90% of whom live in developing countries. Our conservative projections for the purposes of this business case are based on signing up 10 million users by year 5. We do, of course, have much larger ambitions. At a user base of 10 million, we can make over $20 million profit. The financial model is based on well-documented industry averages for generating revenue from a social media style platform. More detailed financial planning and assumptions are available in our detailed investment deck. The financial value of the market we can monetize is huge. The online recruitment market is worth over $28 billion, and entry-level placements is widely considered to be the unsolved problem here. The global internet advertising market is worth more than $319 billion, and marketing to 15 to 35-year-olds account for 37% of that. The online education market, by our royalty by our royalty partners is worth over $187 billion, and we are giving them premium access to their target market. So what is our traction so far? In our first phase, we are focusing on industry and public sector engagement. In the employer category, we've had several large and SMME employers sign up and set up for recruiting youth from our platform. These include global brands like SAPI and ADNOC. In the education institutions category, we are getting exceptional interest from government departments, universities, colleges, and schools. They will promote the use of Wee Meng Thoo Studio to their students. The South African Department of Higher Education is an example. They've agreed to a memorandum of understanding for this. We also have the Global Montessori Group who agreed to a global partnership. Working with NGOs has also been very encouraging. Several global organizations like African Development Bank, Yes for Youth, and United Nations have agreed to mutual projects. We are also currently through to the second round in the process of applying for a grant from UNICEF. So who are we? My partner Peter is an LLB graduate and is also a specialist in social media and marketing. He is a passionate people developer with significant global exposure and work experience. I am an experienced businessman with 18 years experience as an entrepreneur and 2 successful exits. I was the founder of Kaleo People Group, which grew to be one of Africa's largest online learning providers and innovators. We are both now full-time engaged in Wee Meng Thoo Studio. We have also enrolled a high-powered council of advisors made up of specialists from all over the world. We are also in the process of setting up a youth advisory council made up of a diverse selection of our users from all over the world. So I invite you, please join us on this very exciting journey.
Hello and welcome. My name is Adrian King. I'm the founder of Brivio. Thank you for joining me. I'd like to share with you a little bit about what we're doing at Brivio and invite you to join us on this journey. My background is in video and animation production and interactive software technology. 2 years ago, I realized there was a growing need for a fast, automated solution with a specific set of services that are cost and time prohibitive. And I imagined that it was possible to automate this at scale and low cost. And that's how Brivio started. Professionals, small to medium businesses, and enterprise organizations have a growing need to record and share frequent video messages with prospects, clients, staff, and stakeholders. The reason for this is that video is the best medium for inspiring empathy. Text-based email and SMS do not provide the same level of connection as video, and empathy helps us build trust. And trust is the backbone of sales. Brivio caters to a growing global market with multiple vertical vectors. And in the next year, our target market is expected to grow by 20%. The problem that professionals and businesses face is threefold. If they don't include corporate branding on these videos, they lose brand awareness. And if they don't include readable captions, they sacrifice 90% of their audience who watch videos with the sound turned off. And unless their videos are correctly formatted, they underperform on different distribution platforms. Getting these things right in a 5-minute video can take a professional an hour or more using traditional tools. Brivio enables anyone to easily record and prepare videos for multiple distribution formats, instantly apply corporate branding, automatically add readable captions, and ensure brand consistency and add legal disclaimers. And it takes under 5 minutes and requires no training, skills, or special equipment. Brivio is an automatic mobile solution that is as easy to use as everybody's mobile phone camera. It works for individuals, teams, and can easily be rolled out across entire enterprise organizations with hundreds or thousands of users. What we enable for our customers is to create empathy-inspiring videos quickly, frequently, spontaneously, from anywhere at any time, that strengthen brand awareness and recognition, and they maximize reach. They help to protect brand consistency and comply with accessibility and legal requirements, and they ensure optimum playback on all platforms. We've seen excellent initial traction and conversion rates and have a 5-star rating with glowing customer reviews. In the first 7 months of this year, we saw a 493% growth in monthly recurring revenue and a 227% growth in membership. Our client base already includes a government department and one of Australia's leading educational institutions, and we're helping many small brands get greater exposure. We believe Brivio provides investors with a unique and untapped opportunity to reap the rewards of the shift towards better business video communications. Our addressable market includes multiple verticals across all sectors of the global market, including professionals, small to medium businesses, corporate enterprise, government, and events. This target market is expected to grow by 20% next year alone. Brivio has a highly scalable, recurring revenue subscription business model. We have multiple pathways to market, including direct and indirect channels and affiliates and partnerships. We have recorded an 8% conversion from free trial to paying customers, and we believe this can be improved upon further. This is backed up by a robust financial model with a forecast quarterly revenue of $3.7 million in 2 years and a positive EBITDA after just 12 months. As the founder of Brivio, I bring over 20 years of video and technology experience and a deep understanding of this marketplace. We have a dedicated and passionate core team and a highly experienced board of directors, advisory group, and a growing number of enthusiastic supporters. Our focus over the next 12 months is to expand our marketing and sales capabilities in order to grow our monthly recurring revenue, to broaden our affiliate and indirect distribution channels, and to roll out our well-defined product roadmap, which we already have several new feature enhancements in testing soon to be released. We aim to deepen our understanding of and improve our conversion and unit metrics so we can grow our international expansion. The big picture for Brivio is that we see a future in which sending branded and captioned business videos is as commonplace as sending SMS or email. And Brivio provides the tools to make this possible. We are currently raising $850,000 in a Series A at a $5 million post-money valuation. If this opportunity interests you, please visit our deal room on the CRISP platform or reach out to us directly via the contact details on screen right now. Thank you very much for your time and attention, and I look forward to speaking with you personally. Bye for now.
Hello, I'm Rupert Runovich, the founder of Vista, and it's my pleasure to showcase a snapshot of our business today. We were founded in Venice, California, and our aim is to use cutting-edge technology to make life more personal. You've all probably heard or have used a crypto wallet or have your own loyalty card wallet on your devices. Well, we have created the first ever data wallet. As a customer, you will now be the sole custodians of your own data, choosing who you share it with and with the ability to retract it at any point in time. Businesses who receive a Vista profile are receiving a clean, actionable set of data that can be used to deliver personalized services, increase loyalty, and ultimately spend. Gary Vaynerchuk, a well-known and very credible investor here in the US, led our pre-seed. We have very exciting contracts and LOIs with luxury hospitality partners valued around 100,000 USD for year one. Our go-to-market sector of global hospitality, travel, and leisure is rebounding hard and is estimated to be $3.37 trillion by 2022. Our recent accolades include being part of the top 20 innovators in customer experience management, or CEM. We are already a Forbes Travel Guide partner. We won gold in the big data category at the 2021 Open Business Summit, and we're an official sponsor of the Microsoft Startup Partner Program. A quarter of the round is already committed, and we're aiming to close by the end of October. What is the problem we are solving? Businesses currently do not have access to relevant first-party data. They are over-dependent on big data solutions that rarely lead to a real benefit to the customer. With third-party cookies being disbanded and legislation like GDPR being rolled out, businesses need a first-party solution. What's more, with customer acquisition and retention becoming increasingly more difficult, being able to capitalize on each customer interaction is paramount. What's more, from the customer side, there's a real sense of awareness around one's data and also the privacy. And we are seeing app and data fatigue. People want to be in control via their devices, and they don't just want another app. So, how do we solve all of these problems in one? Vista's two-sided marketplace gives access to customer data profiles, which we call a Vista, all in real time, giving management and staff all the relevant data points they need to know about their customer at specific moments in time. Our proprietary radar screen allows staff members to see customers' proximity to them and display actionable relevant data on that customer so they can personalize and upsell what they really want most. To achieve all of this, we have created the world's first data wallet. Customers can securely store all of their personal and preference data with their Vista app. Food and beverage, retail, music, hotel, gym, physio, loyalty, even basic medical data can be stored in your Vista. Once you have chosen to share your Vista, businesses can offer personalized services and offers, driving loyalty and spend. If the Vista member then decides to retract their Vista, they can. Our solution is powered by OwnCloud, secure cloud technology created by MIT as the core infrastructure for a decentralized internet. In terms of our competition, as aforementioned, our customer-centric approach is novel and is yet to be cracked, hence our bold accolade of being the world's first. There are of course hundreds of CRM and CEM platforms out there, and we are competing with the likes of Oracle, Microsoft, and Salesforce. However, we have already established partnerships with two of them, and so we see them as opportunities and not threats. In terms of our TAM, we are going after what is called the real-world personalization gap, and we can share more if needs be. The real-world personalization gap is the gap in the market that is created through hospitality and retail brands' inability to personalize real-world experiences for their customers, and bridge the gap between their online worlds, which are tailored by data, and their real worlds, which aren't. This market opportunity is estimated to be $756 billion globally, with our go-to-market sector of luxury hospitality with a SOM of $533 million. In terms of our consumer, the luxury and leisure traveler has seemingly got that much more luxurious since the pandemic, outspending the rest by 600%. Our team is proven and experienced. I have previously had 2 exits and been heavily exposed to the startup world when I set up an innovation hub in Silicon Valley in 2013. Tahir Ramzan, our CTO, is ex-Google and has a wealth of experience with database and personalization. His passion lies heavily in the crypto space, and we are lucky to have him. We also have Nick Smith, ex-Google, as our head of sales, and Nick Bygraves, who designed the platform, who is a senior art director at Nike. As previously mentioned, we also have Gary Vaynerchuk as an early investor, as well as supplying us with the early contract through his hospitality business, the VCR Group. We have multiple A-list board members, including Jeff Klein, owner of the iconic Sunset Tower here in LA, Bart Melender, ex-head of acquisition at Square, and many more. Finally, the ask. We are looking for a small raise of $1 million at the current 5.5 valuation. The raise will be used to execute against our LOIs and contracts. We're raising using a safe note with a 20% discount on our Series A, which we aim to kick off in Q2 2022. Thank you for listening. If you have any questions, please reach out.
While companies' access to investors has improved, individual investors continue to struggle with access to the strongest, fastest growing companies within our region. What makes WI Capital unique is our commitment to make a difference in this ecosystem. to find the gaps where we can bring our expertise and know-how in order to assist investors and make an impact in their investment management process. We have created WI Capital for investors to participate confidently in exclusive and scalable investment opportunities. This will be alongside a community of investment professionals. We are committed to nurturing your investments through innovation.
So, real exciting array of opportunities we just witnessed. Now, again, if anybody does have a particular interest in any of those investment opportunities, you're more than welcome to engage in a one-on-one meeting via the Brella platform, which you will all have a login to, or via the CRISP deal room where you can conduct further due diligence. Now, our final panel of the day is probably one of the most important topics, which is basically what all our companies who are presenting today are wanting to do, which is secure funding.
And how that relates to investors is that, for the majority of you know, when you're investing into a private sort of early stage companies, they're typically going to have follow-on rounds. And what we've seen over the last couple of years is that more and more investors are actually getting involved in fundraising activities to assist their founders, because there's that old philosophy of if the more time founders spend fundraising, the less time they're actually spending on building the business. So it's something that we're seeing a lot. And in doing that, we thought, okay, well, it's a great way to bring some investors together to actually talk about this as a topic, to educate from an investor's perspective. And from our perspective, it's really simple. The more we can empower investors and founders in knowledge and awareness around the capital raising space, the more we build the ecosystem, the more we create opportunities. And for those companies that do go through sometimes, those challenging times where it is related to funding, I said, and from our perspective, we've seen it many, many times where companies have, had challenges fundraising. They've had an internal member, whether it be a board member or investor, assist, and they've gone on to be incredible success stories. So that's the type of thinking for us when we bring together this type of session.
Absolutely. And you mentioned the time not wasted, but the time taken up by a founder in the raising process. Also the time taken up with investors like yourself in conducting due diligence and trying to understand the investments you're trying to get into.
Which is what you're meant to do, obviously.
Yeah, which is something that takes up a lot of time and sometimes expertise that we lack, which is why we bring these extremely prominent leading venture capitalists from the ecosystem to discuss their processes of analyzing deals as well, so that you can also learn tips in terms of best practice. So with that, we'll leave you to watch the panel and enjoy the rest of the event.
Thank you everyone again for joining us. My name is Lindsay. I'm the Customer Optimization and Community Lead here at Wholesale Investor. It's lovely to meet you. And I think we'll just, kick it off. I would love for everybody to just introduce yourselves and to please just advise us of the firm that you represent and your position that you hold within the firm. And we will start with you, Isabella, please.
Awesome. Thanks, guys. Thank you so much for hosting. My name is Isabella Rich, and I'm a principal investor at Our Innovation Fund. Our Innovation Fund is an early stage VC. We invest primarily in founders and orientate kind of the firm and fund around the people that we back. We have 30 companies in our portfolio, and typical check sizes is around $3 to $5 million as our first check, and then we reserve 50% on for follow-on. My background is I've been at OIF now for 2.5 years. Prior to OIF, I was at BCG, the Boston Consulting Group, based out of the New York office and an Australian office. And prior to that, I had my own little startup, which was a social enterprise in the not-for-profit space.
Wonderful. Thank you, Isabella. Carl, would you like to introduce yourself to us and to our audience?
Sure. Yeah, no problem. Yeah, so I'm Carl Jones. I'm the managing partner at WNT Ventures in New Zealand. We are a pre-seed and seed stage venture capital firm. We're also an incubator as well, so we invest right at the outset, often forming companies. We're focused on deep tech companies, so and we're a generalist investor, although we don't invest into pharmaceuticals or human biotech. So we trend a little bit more towards the sort of hardware engineering type stuff, but we also do some artificial intelligence and quite a range of stuff. We've recently just raised our third fund, still relatively small. We raised about 11.5 million New Zealand dollars, but we receive additional capital from the New Zealand government alongside our funds to deploy. So we're deploying around about a little bit over 22 million in the current fund. Currently got, across the three funds we've currently got 18 or 19 companies in the portfolio at the moment, and we're really hands-on at the outset. Really, help them build from the outset. And a typical check size up front is $1 million, and then we'll reserve capital for follow-on as well. But obviously, we don't go very far with 11.5 million, so we tend to run out of gas at around the Series A and hand it over directly to our LPs often, and others, both nationally and internationally. So, and then recycle ourselves back at the front end. Yeah.
Wonderful. Thank you, Carl. Over to you, Kevin.
Thank you very much. It's good to be in Australia this morning, place where I studied. I'm an entrepreneur, investor, entrepreneurship expert at Oxford Side Business School, founder and director of Concealance Ventures, which is a venture investing platform turning VCs, family offices, and angel networks into end-to-end startup accelerators. We specialize in tokenizing sweat equity to increase speed for founders. We support pre-seed and seed stage deep tech startups because typically they need more than money. They need expertise, very specific expertise globally, and they typically take longer to generate revenue. Therefore, we as our model can support those companies for a longer period of time. Our initial investment is £300,000, but we continue funding the business on an ongoing basis. And I guess I spend my time trying to improve the lives of entrepreneurs by making the venture capital market more inclusive, more transparent, and more efficient for all.
Thank you, Kevin. Over to you, Vela.
Hi, my name is Vela Georgie. I'm the CEO and operating partner at Tenacious Ventures. Tenacious Ventures is Australia's first and only specialised agri-food tech VC firm. We support early stage startups with tech-enabled business models that are helping agriculture transition to a carbon neutral and climate change resilient future. We are an impact fund, so we have an impact mandate. I think we're probably the youngest fund here. So we closed, I had our first close last year, 2020, March. We're a $35 million fund. We've 7 portfolio companies to date. And a check size somewhere between sort of 500 to a mil or thereabouts. As a sector-specific fund, we are very much sort of high conviction, high support investors. We've got deep experience in the space, and we're very hands-on in helping our portfolio through that journey.
Thank you so much. What is so nice about our panelists here today is your funds generally invest in early stage and seed companies. I'd like to hear a little bit about your experiences, why you've chosen to do that, and also what are the risks that some investors might find in investing in these early stage companies. Bella, you're on screen, so over to you.
I guess there's a little bit of an element of where we can deploy our expertise to have maximum impact, but also find that it is often the early stages where startups struggle to sort of get that funding, and so looking for those true believers, people who are both behind the founder and the idea, and so for us there's a very specific appeal of being in that space and looking at what technology and innovation could enable fantastic impact, but at the same time the capability of the founders and the vision that they have to execute something. So it's a pretty unique position versus perhaps somewhere down the line where it's converts a little bit more to unit economics and those types of things. So it's a different kind of, I guess, sort of investment proposition, but with that also different risks. So maybe I'll let some of the other panelists talk about that element a bit more.
Absolutely. I see you smiling there, Isabella. I know you've had a long history in early stage companies. Do you want to tell us a bit about your experience and also what risks you've seen and how investors can really see those red flags before it's a bit too late?
Yeah, it's echo Bella's points. I think when you're investing in seed stage, you're really backing the founder and the person. So typically we see companies that there's a couple of people in the founding team, probably head of sales and CTO and the team around them, but really where what our job is to help them build out that team, scale the initial customers and sales that they have to make it kind of a really scalable and well-run sales and marketing function, and then kind of grow internationally. Australia is tiny in comparison to the US, and typically where we invest, which is B2B software and marketplaces, it's a great position to be in Australia to refine product market fit, get all your ducks in a row, and then use that as a platform to launch overseas.
And do you find do you find that the companies really need to be revenue driving in Australia before they expand? Do you actually want to see that demonstration of ability, or do they come and say the market's too small, we need to expand, and then we will be able to show you those returns?
I think it's different for different industries. For example, ag, I think, would have a little bit of a different view. For B2B software and marketplaces and even consumer, you typically revenue is the easiest proxy because it shows that you can sell and that customers want the product. But I think there are a number of other proxies that you can use, which is customer acquisition, customer growth, and things like that. You see there's a lot of companies that don't start off with revenue, but harness a huge customer base and then kind of work out where they can charge and where they can upsell customers. So typically, to answer your question directly, the market isn't too small in Australia to demonstrate those things, and usually you can build a pretty good base before then you go overseas.
Thank you. And Carl, what do you think about that, given that New Zealand is quite small? So that would be a challenge from a market perspective, given your experience. What do you want to see from the companies you invest in?
Yeah, New Zealand isn't a market, right? I mean, we're smaller than probably Sydney just about these days. Yeah, look, I mean, they need to have a global view from day one, really. But in saying that, New Zealand is also quite a good testing ground initially, just to roll it out in a safe environment. I think many of our founders, we're not that small, but a lot of them kind of know the customers, and you can get in front of them pretty easily. So showing customer traction in New Zealand is okay, and it's good to bring revenue in, but realistically, until they get offshore, I think any real serious investor kind of somewhat discounts the revenue traction in New Zealand. I might be causing offence here. But we're a pre-revenue investor at the outset, right? So we always invest into pre-revenue companies. So we often don't have the luxury, or we always don't have the luxury of reviewing traction to make an assessment as to whether there's a good opportunity here. So, you know, there's a lot of additional elements of risk where, you know, trying to determine whether someone's even going to want to buy what the technology platform is creating in the first place. You know, there's some real challenges around that. And then on occasion, we're also we're spinning technology out of universities and research institutes. So, you know, sometimes there's no team either. So we're not even investing in founders. We're literally investing in, you know, the potential of some IP. So, you know, we really see ourselves as being, you know, the building blocks, and really, you know, diving quite deeply at the outset to, you know, to make sure the companies are built really well. Because if they're not, those, you know, if you miss something in there, then, you know, that may not crop up for a few years until the Series A or Series B, and, you know, and that's sort of a bit too late by then. So, you know, really strong focus on intellectual property from our perspective, really diving deep on the potential of the market. You know, I mean, and what, you know, like any other good company, you know, market validation is absolutely critical, but you've got to do it in quite a different way, I think, from the outset. So it's a lot of additional risk factors, but you know, overall, risk also potentially comes with reward. Right?
And with your with your investors that want to invest into the fund, how do you express that risk to them, that they are aware that sometimes these are just ideas?
Yeah, you know, I think it's interesting. We, you know, being in the deep tech space, it's you know, I think there's a pretty strong trend in the last, you know, let's call it five or so years towards deep tech investing, and I think it's a little bit hand in hand with impact investing as well, right? We're not an impact investor, but they kind of go hand in hand to some degree, because you're making quite significant changes in the world, where you can do. And so I think from that perspective, that's certainly attracting a certain type of investor into the funds. We're also fortunate in the sense that we do get government capital to, you know, to de-risk some of that. You know, we're part of, you know, New Zealand government sort of Callaghan Innovation Technology Incubator Program. So we, you know, the $1 million that we get some government funding to help de-risk some of that for the investors, and that naturally makes it an attractive opportunity. But, you know, we can't stand on that in our own, you know, without standing on our own 2 feet. So we're, you know, even though we are investing that early, we're still a very high conviction investor. You know, we're not a spray and pray investor. We dive deeply in a whole range of areas before we get in. And so, you know, we would only really do sort of 5 to 7 companies per year, you know, and we'd look at, this might be small internationally, but, you know, we'd look at about 350, 400 companies per year. Yeah. So we're quite selective, right?
Yeah.
Yeah. And I think you kind of have to be, right? And you're never going to get them all right. But you know, hopefully from the back of that, our hit rate is certainly much higher so far of successes. But you know, we're 7 years old. We're still relatively early in our own journey. You don't tend to raise a third fund without doing okay in your first couple of months.
Exactly. Exactly. Track record, right? Is what we want from our founders, but we also want that from our funds. Yeah, exactly. And over to you, Kevin. How do you really mitigate that risk with your investment fund, and also given, you know, you use technology actually to analyze these deals? Do you want to tell us a little bit about that, because we're finding this industry still a little bit paper driven?
Yeah, the industry is completely paper driven. It's back in the 80s when in the stock market, where people were making orders with a piece of paper and a cell phone. We've added Excel to this, and that's pretty much kind of the tech stack of most VCs. So we've created the whole tech stack to power the VC industry, to leverage digital transformation without having to move away from the traditional model, the traditional LPA. So We see ourselves as the plumbers of the VC market. We are helping VCs to leverage their communities, to engage their communities at a much more deeper level than you would have on Twitter and LinkedIn. And we are creating an incentive model at the back of this to let those VCs manage their communities, incentivize their communities, so that everybody can participate, or the most qualified people can participate in the selection of the company. So this is where the technology comes in. It's effectively the process. The whole process is digitized. How do you find a company? How do you understand sentiment analysis? How do you identify the gaps of that company very early on? Because like most of my peers right now, we invest very early, and there are gaps all over the places. I've been working with many entrepreneurs for the past 7 years or so, and I've never seen any company perfect. Perfection does not exist, even in VCs. So what we can do is we can try to be quite humble about how we approach investing in startups, and look at how where the risks are and where the gaps are in the company, and do something very early on about those gaps. And this is where our network effect comes in. So combination of technology and network effect. Here, when we have a company that has gaps, we identify it very quickly, and we identify the solution very quickly as well. And that can be someone in New Zealand, or that can be someone somewhere in Sri Lanka or whatever. We don't really care. What matters is the expertise, it's the skill, it's the availability, and it's the alignments with the company's vision, because everybody get paid with the shares of the portfolio. As I explained, the fund is tokenized. So we're focusing mostly on deep tech and med tech and fintech for various reasons. There are not a lot of VCs that can do the three altogether, and you are also very well exposed to very interesting technology at the intersection of fintech and medtech as well. You can package IPs and create insurance product as an example. But fintech and medtech are big market, so we're focusing on this because we've got the network, and because the market is growing. So that's how we're looking at de-risking portfolio and empowering VCs and portfolio companies.
And what did you see was the biggest trend during 2021? I guess that will be our pandemic years. What did you see was the biggest trending industry, and also how did your pre-seed companies actually navigate the pandemic?
Question for me?
Yeah.
Thank you, Lindsay. Without any question, the most funded sector in 2021 is fintech. It has doubled the investment in 2020. So I think it's a record of 50 plus billion in H1 2020. So it's by far the most funded industry. It has pros and cons, right? I think we shouldn't be too biased towards only funding fintech companies, because of course there are only so many dollars, believe it or not. I'm not going to make any comment about the central banks. No, but what we should be able to do as investors is to understand that our money and the money of our investors, it's a way for voting. We're voting for what we want to see, how we want to see. We're voting to shape the world in the next 5, 10, 20 years. And if we're only putting our dollars in fintech startups, then we obviously are going to have problems in other sectors. So I'm a massive believer in trying to equalize how capital is distributed across industries. One of them being fintech, agri-tech, and energy and impact. I think we should be able to do that. So from our standpoint, we are completely agnostic. We're growing our network and our communities to do more in all of the sectors. So we meant to be completely sector agnostic.
And that's a nice segue into you, Vela. How did you find the agri-tech sector, especially in these pre-seed stage companies? How did they navigate through the pandemic years?
I think it's a little bit interesting in that we closed our the first close was at the start of the pandemic. Our final close was this year. So we as a fund were also completing that last round of fundraising during the pandemic. So from that perspective, I guess, very appreciative of the journey that some of our startups were having to go on during that time. But equally, the pandemic has probably brought a little bit more to the forefront of everyone's mind, sort of the impact of climate change. So population growth, water scarcity, climate variability, all of these things are sort of more common talking points, and people are definitely more aware of that. And I guess to some extent that ability for consumers to vote, to some extent, as Kevin said, and for that future to be shaped. So that sort of push-pull effect of consumers being more aware of how their food gets produced, the carbon emissions that might be associated with that production. What is the food producer doing to minimize their emissions? How are they engaging across the supply chain and those types of things? So in terms of probably sectors that we've sort of seen this year, in partly, might be sort of around the carbon emissions, definitely. So there's been a bit around that space, and as well around the alternate protein. And I think sort of those two tend to speak a little bit to where people have found themselves or what they're thinking about in the last 12 months. But also, I think as a industry, agriculture to some extent has also been heavily impacted by the pandemic in perhaps ways that people don't necessarily see. So labor shortages on farms to be able to pick fruit, and sort of produce it, and that necessitating both, innovation to not only enable, automatic picking or those types of things, but then also what happens along the value chain to extend life, or the waste that might be associated with food and those types of things. So there's quite a lot of disruption and the like that has been highlighted or sort of gaps. So it'll be interesting to see in even maybe the next 12 months what sort of comes through as investments towards are precipitated by the pandemic itself.
Yeah, absolutely. And especially, I know it's a little bit out of agri-tech, but in terms of how we recycle plastic, we were doing so well. We got rid of the straws, we got rid of single-use plastic, and then we went with full single-use PPE garments made of plastic. Where are we? Have you seen anything? Where are we in trying to mitigate all that type of plastic that we've probably produced more plastic in the last 2 years than we have in the last 20?
So it's quite interesting. We do get quite a number of startups approaching us with innovative packaging solutions or those types of things. But at the same time, we also have, so for one of our investment companies, for instance, GoTerra is essentially the processes waste, and they have come up with a modular solution for the processing of waste using insects, and the ability of insects to process that kind of various waste streams in an efficient manner and those types of things. So there is, I guess, sort of the two things of innovative packaging, those sort of things, but fundamentally there is also going to be some type of waste, and we need innovative ways in processing that as well. What we have found with some of the packaging and those types of is sort of assessing essentially the venture scale nature of that solution, but also how it sort of sits along that value chain. So there's often, I guess, a bit of deep tech that might come along in coming up with a innovative solution, but being able to have the adoption happen along the supply chain for it to be realized can sometimes be where the challenge is. So taking the perfectly valid idea or something that's got potential, but then actually having that that product market fit and the business model is sometimes where the difficulty is for us.
Thank you. How did you find it in New Zealand, Carl, with your customers? Because, almost a lot of your revenue comes from your tourists.
Yeah. Look, I mean, bulk of my companies are pre-revenue anyway, so that it wasn't an issue for them. Right? That they were quite used to surviving on very little money and kind of muddling through, to be honest. Look, I mean, it's I think it's probably more challenging for our companies when they're trying to expand globally, and you've got a team here in New Zealand, trying to establish a manufacturing plant in Australia or the UK, and certainly with our border controls that we've got in place, where it's easy enough to get out of the country, but actually it's the getting back into New Zealand is the hard part, right? The shut down. They might have families and they've been away for a month, and then they've got to spend 2 weeks in a quarantine system, and that starts to become pretty challenging to manage, right? And then not least, the attracting talent into the country, which I think that's a global problem, right? Is talent shortage, and exacerbated by a country of 5 million people as well. So finding innovative ways to deal with that, I think, has been really interesting. There's a lot more usage of offshore developer teams, for example, in Ukraine and Philippines and elsewhere. So I think we're seeing quite a bit of a trend around that. From a customer perspective, though, at the end of the day, many of our companies just have to get offshore. I think one of our faults here in New Zealand potentially is we're running behind in terms of opening up and just getting on with it, because I think we have to. I don't know what it's like in Australia, but and it's a scary thing for a lot of people here, because we haven't borne the brunt of it of the rest of the world have. So but some of our founders are just getting offshore and getting partnerships done and doing deals and getting it done, and then they're back in, and it's great to see, and it really I guess drives shows the commitment of the founders, and full credit to them. It's a tough environment, and when you're trying to do a startup, which is damn tough anyway, it's just tough. It's hard work, but.
And Isabella, how did your companies go, and your sort of sectors go during the pandemic years?
Yeah, we were very lucky, and I can't say it was all by design, but 8 of the 12 portfolio companies in our first fund were remote working using sometimes. So companies such as Go1 that provides corporate learnings and is kind of the Netflix for corporate learnings. They recently just raised from SoftBank, to Onboarder, which was actually an onboarding tool where in COVID they very quickly kind of added a whole kind of stream around onboarding and offboarding and COVID related kind of onboarding issues specifically. So in that sense, it was a very interesting time. We also were raising our second fund kind of the week before COVID started, and we got together and for 2 hours kind of went through the portfolio and go, okay, well, what's COVID scenarios, what are the kind of, if they decrease revenue over the next 12 months by 50%, what does that mean? How do we help them in these times? And kind of 6 months later, I think 6 of them had their record quarters. So that was more luck than by design. But for what we're seeing, I think, 3 themes come to light. I think, remote work, definitely full steam ahead. We've recently invested in a company called, and gosh, I'm now having a mind blank, Vouch For, which allows companies to do kind of remote customer testimonials through video format. And they've seen incredible growth during COVID. I think the second theme is I would echo the fintech, but from a crypto stance. I think we're at the beginning of an evolution of decentralized finance, and I think we're at we're just skimming the surface at the moment in terms of the use cases for blockchains, but then you kind of go into NFTs and all of these applications where people are still trying to work out product market fit. But, just in terms of ticketing, you take that alone, and the benefits of, NFTs and what they can provide to ticketing is huge. The third, I would say, was in gaming. And I think gaming is seeing a very similar evolution to what the internet did 20 years ago. There was a great graph by Morgan Stanley that they put out, 2004, 2005, which talked to eyeballs on the internet versus advertising dollars. And I think we're seeing the same now, where if you look at eyeballs in the gaming ecosystem, it's just astronomical in comparison to any other industry that I've seen. But people are just working out how to monetize and what are the kind of infrastructure plays and niches that you can go into. So, for example, there's a company called mod.io. They provide the infrastructure for individuals to develop what's called a mod, which is like an element to the game that is a user-generated thing that all gamers can use. And so I think there's a couple of layers of this gaming world, one being advertising and two being kind of the infrastructure layer that we're just going to see more and more of.
Now, something that I wanted to ask you is, so with those companies that have experienced something like exponential growth during COVID, how do they then manage their expectations coming out of the pandemic that exponential growth is something they're not going to have? And from their perspective, in terms of coming back to you as a VC to invest in them, do you have those expectations that they continue those massive growth cycles?
Yeah, it's interesting. You speak to any kind of technology equity investors in the public markets as well, and particularly around internet marketplaces and consumer goods. It's this, like, I don't think anyone really fully knows how to forecast, from here on in. I think we operate in a different space to equity investors, where they're really having to kind of get their forecast down to, an nth degree, where what we say to ourselves is, how big is this market? How much do they capture today? And if they experience, let's call it 70% of the growth, or 50% of the growth that they did last year, like, they're probably still very underpenetrated in massive markets. So it's, having a fund life, which is a 13-year fund, makes it's less about the kind of next quarter's earnings and more about where you think the opportunity can be over the long term.
What do you think about that, Kevin? Given that, your main industry was fintech, which exploded, is to really understand what are the revenue models now outside of exponential growth? Because I've been through exponential growth, and you really want to start to bank on it, but you can't.
Yeah, well, you have that level of unpredictability when you're coming early on, and you need to be very comfortable with the fact that startups may have to pivot and change their revenue model and their distribution and so on. So there's no magic, or there's no science. It's only going through the usual test and learn kind of feedback loop. So some companies are sticking with the same model. Some have benefited from COVID and have experienced growth beyond expectations, and some had more challenge to adapt to the situation. I think you can only appreciate that your strategy is as good as your first punch in the face, right? And that's pretty much why I think nobody could anticipate COVID, but by working closely with the companies and trying to bring people who have gone through crisis, we invest in. We don't have that kind of any restriction around age, but the majority of the founders we've invested in, they are somewhere between their 30 and 50s. But the network that we have, they are probably our global network of 250 plus. Experts, they probably have about 30 to 40 years of experience, and therefore they've seen a few crises. And there's nothing better than someone who's seen a few crises to tell you how even if they are not the same crisis. I'm by no means comparing GFC with COVID-19, but I think when you have been in tech for 30 plus years, and you know what it's like to go through the dot-com bubble, for example, then you have some self-defense mechanism that are already there for you. And the truth is that most founders, especially when I'm thinking of Carl, where I suspect that the majority of the PhDs don't have 40 or 50 years of experience, then they have. I'm sure there are some exceptions. I'm by no means making any generalization here, but when of universities, and you've got those very young people full of energy, but they are naive, right? And we all were when we were coming out of university. So bringing people bringing the wisdom around them, and making sure that they don't feel like we are judging them to assess whether we are going to reinvest. It's about having that very vertical relationship as opposed to horizontal relationship versus vertical relationship. We're here to help. We're here to help those companies, and we want them to tell us where their pains are, and we're not going to use that against them at the next round. We really want them to understand that we want their best. It's in our interest to know where they need help. Because we've got the bandwidth and the network to help, and that's something that is very important to cultivate within the portfolio. It's that proximity with the founders, no matter what you're going through, basically.
Is that why you only choose a handful out of hundreds to invest in?
Well, so we've reviewed about somewhere between 800 to 1,000 deals a year, but the truth is that there are about 50% of that are not even relevant to us. And so we're literally looking at in depth about 200 deals a year in depth, and that is and we've made 7 investments. But there is also that chemistry that you're looking for as well. That even if the business is very good, you need to work with founders that want to work with you and not just want to take your cash and run away. We've seen many founders, they think they've got it all sorted because they've been through some of those universities and they got it and they're going to rock it. And we're like, well, you're doing your first startup, ask the ones that have done a few and you'll see if that's easy. And so we're laughing sometimes because you can try to open their mind, but some founders just don't want to work with you. And we've got pretty clear cut on that. If you don't want to work with us because you think you don't need us and you just need the money raised from one who's just going to give you the money, that's not our ethos.
Yeah, a lot of our founders, want to know why you won't just invest on the spot. A lot of them have that expectation. Is there some advice you can give our audience today in how to really get into the mindset of the investor? Because for the most part, we're hearing the same thing from our investor groups coming back, is we want partnerships, not just, a signed check.
Yeah. So is that for me first to answer,
Yes.
Lindsay? Yeah. So I guess our model is very typical once again because we're starting from the problem and not from the not from the emotional trigger because this is a massive, exciting opportunity. We're very much looking at, okay, what is the problem you're trying to solve? Are you in love with the problem? Do you understand how big this problem is for the market that you are addressing? But that's not where we stop. We're looking at, okay, what can go bad here? And our job is to reduce the risk. So what we love about the founders that are applying to us, and when they strike forward on the first call, they say, guys, I'm doing this. I love the problem. The market is so big, but these are all of the problems I need to get there. And they start by telling us the problems, because we are entrepreneurs, we are operators. We know that there are problems. If you're trying to hide, and if you're trying to say, oh, everything is fine, I'm flying right now, give me the cash, I just need a view. We're going to say BS. We know it's not true. We've done it before. So we're just going to have very, very honest relationship with the founder, saying, tell us where are your biggest pains right now. And it's not because this is, by the way, we don't reject startups because they have many problems, because we've got the network to solve those problems. So we're very comfortable investing in companies that have problems. What we're not comfortable is we are not comfortable investing in founders that they think they don't have any problem.
That's amazing. Vela, what do you think about that from that social impact perspective? Is that something that you're also looking for in your founders?
Yeah, I guess probably the way I view it is that when each time we make an investment, we're taking a risk, right? We're taking a gamble on the founder, on you, essentially, the people listening to this panel. But we also have to do right by our investors. Right? So we, as a firm, are essentially the conduit between our investors and the founders. And so our investors have entrusted us, and in particular as a sector-specific fund, as people who are knowledgeable within this space, to find opportunities that allow capital to be deployed to meet a specific objective. And in our case, that's to work towards a resilient future, and to find the best opportunities that enable that impact. And so when we look at the startups and when we talk to them, there is, like Kevin said, this deep understanding of the industry and the problem. But then there is also the founder. It's early stage. It's seed. There isn't sometimes attraction or the revenue or the metrics there to speak to that. So it's about the founder themselves and the characteristics of the team, that they're continuously learning and coachable, that we can build a relationship with them, that we can have a partnership where we can support them not only with our network, but that interpersonal relationship. So them wanting to work with us is just as important as us wanting to work with them. I don't think that could be understated at all. I guess there's that element of being able to understand their personal characteristics, the level of self-awareness. Do they understand what those challenges are, the gaps? We're not looking for people that have all the solutions, but again, as Kevin said, we're looking for people that understand they don't have all the answers, and that they're willing to work with others to get there, and sort of that intelligence and capacity and hustle and grit all come together. So for us, I guess, we do like to get to know our potential founders and sort of potential investing companies as early as possible. And we do have an element of sort of behavioral interviews as we progress through some of the investment processes, because at the end of the day, we're investing in the founder. An early stage investment is a gamble on the founder as much as the opportunity itself. And so that really does form part of the investment decision.
Wonderful. Carl, I'll get to you at the end because yours is a little bit different with the incubator, which is really interesting. So I'm going to jump to you, Isabella. What would you give your advice to the founders that just want to know why? Why can't you just decide today?
So the best short and sweet quote that we always laugh at is that the average relationship with your investor lasts longer than the average marriage in the US. And so there's going to be ups and downs, and we're typically investing on the up, But really, for a founder, you want investors who will continue to support you when you hit roadblocks and when you get punched in the face. And so I would say to founders, it's actually more beneficial to you in a lot of circumstances than to us to really get to know your investors, because it's one thing deploying $1 million or $3 million of first check when things are going well, but can you say to yourself, hand on heart, that that when things don't go well, investors will continue to hit the streets and fundraise for you when you can't fundraise, or get your customers when you're having trouble selling? And I would advise every founder looking for investment to who's going to a venture capital fund to ask the VC if they could speak to the companies that haven't worked as well as the companies that have, because I think the proof is in the pudding, where you have, every VC portfolio has had companies that haven't gone exactly to plan and haven't worked. And you want to know that your investors are going to be there to support you, whatever the outcome of the business is.
Yeah, I love that. For every success, how many have failed? We learn more from our failures than we do our successes, because we're successful. What do we need to learn? But when we're not successful, there's some really hard questions that need to be asked. And then finally to you, Carl, what would you say to those investors? Because you're really getting them right at the beginning. You're getting them at that incubation stage. And just as Vela was saying, you're talking about, are you looking for them to be coachable and willing to learn at that really incubation stage?
Yeah, yes. Look, I'm not a big fan of no offense, I'm not a big fan of the coachable word, really. It feels a bit kind of, well, we know everything and you don't. So I personally just try and avoid that. But, I think, we deal with a lot of, engineers and PhDs who have been working on whatever they've been working on for a really long time. And so you've got to be really respectful of that, right? They've put their life's effort into it, and their academic life effort into it at least. And so when we get technology and academics coming to us, we so often see that it's a solution looking for a problem, right? Which is sort of the opposite of what we're trying to look for. Now, that doesn't mean we won't invest. It just means we have to look at it in quite a different lens. So, we're trying to get in, and much earlier to help with the education piece around that as well, and get people, before they're even thinking about becoming an entrepreneur to think of it in a slightly different lens. And then once we sort of see that, there is something there, one of the next hardest transitions we see for founders is the transition from building value in their product or their technology to building value in their company. Yeah. And that's a really hard transition for a lot of people, right? Because their happy place is their widget or their technology and their lab and doing that, and so they kind of naturally gravitate back towards doing that. But at the same time, they've got their commercial hat on, and they're trying to build this entrepreneurial expertise, and they don't always go together, and sometimes they work really, really well. So it's an interesting approach, so I think from a founder's perspective, particularly from academic founders or someone who's perhaps not come from the entrepreneurial world quite so much, I think really trying to I don't want to reiterate something Kevin said earlier around product market fit and your market and all of that sort of stuff, because that's absolutely fundamental, and your problem and talking to your customers, absolutely fundamental. But also starting to understand the drivers and the economics around it. If you're building a piece of hardware, we invest into quite a bit of hardware. What are the unit economics attached to that? It's quite different to a software play. And again, just trying to move that transition of, is there, is your great product able to become a great company? Yeah. But then taking it another step further, from an investor lens, we add one more step onto that. Can your great company also be a great investment? Which are not always the same things, right? You often hear talk about a VC backable company, versus what is actually a really good, good lifestyle business, good SME, really for the most part, So then that's the difference probably between the investor lens and the technology or the company builder lens. So, trying to understand that, typically, not always, but typically investors are financially motivated to some degree or another. People want returns. So understanding what the investor return dynamic looks like, I think probably goes some way to help to understand the investor mindset a little bit as well. What does an investor need to see at the back end of it? How does even taking a moment to understand how a fund works, how the fund dynamics work from a investor into a fund, and the returns and the requirements on an investor to give money back, and within a period of time, and and what stage is the fund at in its investment phase. All those are actually really quite important pieces of due diligence that a founder should be doing on their investor every single time, right? Shouldn't be just the investor doing the diligence on the founder. So
yeah,
absolutely. Not sure if I even answered your question there.
It's a relationship. All of it's a relationship, right? I think our final question that will close the panel off today is, what do you want to see from your founders in order to go into the next round of their cap raise?
You're starting with me there? Or?
Yes.
Okay. What do we need to our founders to see? Look, at that point, again, we've got a range of different companies, but we really want to see the market and the customers being understood much more clearly. We want to see them starting to understand the customer journey, and how does their product map within that. We're really wanting to see the intellectual property strategy built as part of a wider business strategy. They're not two independent things; they're a core part of the same thing. Really understanding how the team is going to be built, and what does that look like. So just more of the building blocks, really, and starting, if we can get some traction, then that's fantastic as well. Real traction versus sort of your friends down the road sort of putting a bit of money in. But yeah, so really a bit of traction and a better plan than what we started out with, really.
Yeah, so you want to see them very much shift between that being a good product into being a good company.
Yeah, that's right. Yeah. Shifting away from building their product in the lab to actually, how are we actually going to start selling this? What are our channels? Who do we need to talk to offshore or in the industry to start building pathways to either get product in hands or bring or attract new investors on board as well. So yeah.
Thank you. And you, Kevin, what would you say to your founders? What do they need to do to go from that £300,000 check to the next million or million pound check?
So there's no one size fits all. All companies are different. We've built the technology to track their progress and to help them to report to their shareholders. So we are measuring a number of metrics for our companies based on their sectors, their maturity, their geography, and so on. So it's again, for a medtech company, it's going to be FCA approval, and for a fintech company, it's going to be customer pricing and so on. So those metrics are designed on a deal by deal basis, and for us, what we want to see is progress, right? And it can be measured in different ways.
And Uvella, what do you want to see in your founders and your companies?
A bit like both what Carl and Kevin said, I guess to an extent, when we make an investment, it's based around a hypothesis at the early stage. So we and investors have a hypothesis, and they're in that sort of maybe first 100 days when we first invest in the company, we might sort of think about what are the metrics, what are the KPIs that we want to see evolve, how do we do our impact reporting. So we put together a bit of a framework that allows us to understand how that startup might be progressing through its phases. And we also recognize that the hypothesis can change. The business model can change and evolve with market demand, circumstances and those types of things. And so it's a little bit of, as much as anything else, progress towards agreed goals, and yet knowing that at any time those goals can shift. And so when they do, it's also looking at it, taking a step back and looking at it almost anew, like a new opportunity, and sitting down and sort of taking almost a beat to reassess and sort of have a look at, is the market still the same? Is the opportunity still the same? Are we still aligned on the impact that we want to deliver? Can we still provide meaningful support and those types of things if there is going to be that shift? But more than anything else, it's progress, and that can be measured in many different ways.
Isabella, do you want to tell us a little bit about how progress can be measured?
Yeah, it different for every company. So not that helpful from a tangible perspective. But what I will say is probably two things come to mind, and there's an assumption that obviously the business is progressing, but the two things we probably look for is under promise, over deliver in what was set out to begin with, and then the second is founder integrity, which is not everything is going to go to plan, but if you can see that the founder has integrity in what they're doing, integrity in how they treat their staff in challenging times, the assumption that the business still can continue and it's still an investment. I think a good investment, those are the two things that I would say. There has been decisions that have been made because not that we don't think the opportunity that is there, but throughout COVID, the way that a company dismisses staff is something that we will look at in kind of forming a decision which goes beyond just metrics, but really how we think that the founder and the kind of founding team treats people around them, both the customers and their staff.
Is it a red flag for you when there's a big staff turnover?
Yes. One of the things that we look for is, tenure, like average tenure in a company, reasons that people leave. We do interviews with, current staff and previous staff. There's always going to be churn when companies raise money, because you're going from a business which is probably like a great lifestyle business growing at X%. Suddenly you get $2 million and there's going to be like a significant cultural change in the business. So, there's always going to be that churn, and that's something that we don't worry about. But if there is significant, churn within the business because of, certain issues within, the founding team or culturally, then absolutely.
We're good. Okay, everyone. Thank you so much.
Thank you for joining us for day 2 of the STEM Virtual Investor Conference. Hope you've enjoyed the sessions. My team has worked day and night to actually put this together for you. I hope you enjoyed the companies presented. And more importantly, our hope is that you walk away from these last 2 days with a better understanding of, firstly, what's happening in each of these areas, a vision for what you understand what the future could look like based on, I said, the different companies that are coming through and the different presentations and the panel sessions and so forth. And you found some opportunities which are of interest to you, obviously, which you found inside the Brella app and also inside Chris. And you've got your own investment thesis for going forward. Like when we think about the end and how we want to contribute, I said everything we do is about creating an opportunity for tomorrow. This whole conference is about that. Whether it be investments that you make that are outside of our ecosystem, or whether it be you making investments in the companies which presented today. I said either way, it's about creating something which doesn't exist, and we will work day and night to make sure that sort of thing happens. And more than that, I said some of the speakers which you saw as well may have provided you with the insights that you may not have been thinking that could make a transformational difference. So we're always going for that 1% that can make a difference in this space because we know how it works and we know how this transformational impact happens across STEM and what that can mean to your portfolio. So saying all that, again, all the companies are inside Brella. We're leaving it on for the next few days. So please network, engage, chat, set up meetings. Go and look at the information inside CRISP. Obviously, there's a whole bunch of information inside there. Thank you again for joining us for STEM. We've really enjoyed being able to bring this opportunity and bring the conference to you.